Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about the master himself, Warren Buffett. Forget all the noise, the day trading apps, the complicated charts. Today, we're going to get back to basics and break down his incredibly powerful, time-tested strategy, all based on the fantastic book, The Warren Buffett Stock Portfolio. So, ready to see how the best in the world does it? Let's get into it. I want to kick things off with this quote from Buffett, right in the middle of a nasty recession. Now, just stop and think about that for a second. Everyone else is panicking, watching their accounts get crushed, hitting the sell button, and Buffett says he welcomed it. He saw the whole thing as a giant fire sale. That right there, that's the mindset that sets him completely apart from pretty much everyone else.
And that really leads us to the core question we're tackling today. How on earth can the guy who's made billions get excited when the stock market is in a total free fall? You know, the answer to that question is literally the key to his entire philosophy, and it's exactly what we're going to unpack piece by piece. So here's how we're going to do it. First, we'll look at that counterintuitive strategy. Then, we'll figure out how he finds those amazing, long-lasting businesses. After that, we'll dive into his brilliant equity bond theory, learn how to actually calculate a stock's value, and even run a real-world analysis. And we'll wrap it all up with what might be the most important lesson of all.
All right, first up, Buffett's core strategy. The main idea is famous, and it sounds so simple, but it's incredibly hard to actually pull off. It's this: be greedy when others are fearful, and be fearful when others are greedy.
Now, this isn't just some catchy phrase. It is a very specific, repeatable system. So during those go-go bull markets, when everybody's making easy money and getting super greedy, what does Buffett do? The exact opposite. He's often quietly selling and just letting cash pile up. The experts on TV might say he's lost his touch, that he's out of the game, but he's not. He's just being patient, building up a huge war chest for the storm he knows is coming.
And I mean, the amount of patience we're talking about is just staggering. Get this, in 2007, right before the great financial crisis hit, Buffett's company was sitting on $37 billion in cash. So when everything fell apart, when the whole financial world was on fire, who did the biggest companies in the world call for a bailout? The guy with the cash. He used that money to get unbelievable deals with giants like Goldman Sachs because he was the only one with the money and the guts to make a move. He literally turns mass panic into a golden opportunity.
Okay, so having a mountain of cash is one thing, but what do you buy with it? This is where Buffett gets extremely picky. He's not just buying random stuff because it looks cheap. That's a huge misconception. No, he's hunting for a very specific type of company, one with what he famously calls a durable competitive advantage. The best way to think about it is like a castle with a giant moat around it filled with alligators. It's some special quality that protects the business from competitors. You know, a brand people love, like Apple, a secret recipe, like Coca-Cola, or just being the cheapest guy in town, like Walmart. That moat makes sure the company's profits aren't just a flash in the pan. It makes them predictable, consistent, year after year after year. So, how do you actually spot one of these companies? Well, the number one clue is a history of consistent earnings. A company with a real advantage, a real moat, has financials that just steadily tick upwards. It's predictable. But a company with erratic earnings, its profits are all over the map. They're vulnerable to, well, everything. Recessions, new technology, you name it. Trying to predict where a business like that will be in 10 years is just a dangerous, dangerous guessing game. And this chart right here just says it all. Look at the left side. That's Coca-Cola's earnings per share. It's just a beautiful, steady, upward climb. Predictable. Now look at the right. That's Ford Motor Company's book value. It's a complete roller coaster. Up, down, even goes negative. So let me ask you, which one of these businesses would you feel more comfortable predicting the future of? For Buffett, it's not even a question. Okay, this next part is maybe one of the most brilliant ideas Buffett ever had. It's a total mental shift. Once you find one of these amazing predictable companies, he says you shouldn't think of it as a risky stock. You should think of it as a very special kind of bond. So, quick refresher on bonds, right? A normal bond is basically a loan you give to a government or a company. And in return, they pay you a fixed interest payment. It's called a coupon every year. You buy a $100 bond that pays 10%, you get $10 every single year. It's steady, it's predictable. Buffett's genius was realizing that the stock of a truly great company, one with that deep moat, behaves in a really similar, predictable way. And here is the absolute game changer.
Unlike a normal bond where that $10 coupon is locked in forever, this equity bond gives you a raise every single year. The company's earnings per share, that's your coupon. And because it's an awesome business, that coupon grows over time. It's like a bond with a built-in compounding pay raise. How amazing is that?
So, does this actually work in the real world? Oh yeah. Let's look at his legendary investment in Coca-Cola. When he bought it back in 1988, his initial coupon, his return based on the price he paid, was a solid 6.8%. But Coke just kept growing and growing its earnings. Fast forward 23 years to 2011, and that same investment he made decades ago was now spitting out a compounding annual return of nearly 12%. The coupon didn't just stay the same, it exploded.
Okay, so the theory is fantastic. We're looking for great businesses that act like bonds with coupons that grow. But how do we know if we're paying a fair price today? How do we actually put a number on all this?
Believe it or not, the process is pretty straightforward. Step 1, you look back at least 10 years. Do the company's earnings per share have that steady upward trend we've been talking about? If they don't, you stop right there. The business is too unpredictable. But if they do, you move to step 2. You calculate the historical annual growth rate. How fast have those earnings been growing? And finally, step 3, you use that past growth rate as a reasonable conservative guess for what your return could be over the next decade.
All right, let's stop talking theory and get our hands dirty. We're going to run the numbers on a real company from Buffett's portfolio around the time this book was written, the retail giant Walmart.
First things first, we got to figure out our starting coupon. So, back in 2011, Walmart was earning about $4.45 per share, and the stock was trading around $54. You just divide the earnings by the price, and you get an initial yield of 8.2%. That's a really solid start. But remember, that's just the beginning.
Next up, we look at how fast that coupon has been growing. And when you look at the previous 10 years, Walmart had been growing its earnings per share at a super consistent compounding rate of 11.49% a year. This right here, this is the engine that's going to drive our returns.
And now for the magic. When you put it all together, that nice starting yield of over 8% and that powerful, consistent growth rate of over 11%, you get a total projected annual return of 13.19% for the next decade. And that's the number that matters. A predictable, low-risk 13% a year? For an investor like Buffett, that is very, very attractive.
So we've gone through the what, the why, and the how. But the book makes it crystal clear that all those calculations, that's actually the easy part. The final, and honestly the most important lesson, isn't about spreadsheets or numbers. It's about your temperament. It's all about your mindset. This is the real secret. It's about being able to completely ignore the crazy, day-to-day noise of the market and just focus on the quality of the business. It means being disciplined, only buying when the price makes sense. It means having the guts to build up cash when everyone else is out there gambling. It's about thinking in decades, not days. And maybe most of all, it's about having the patience of a hunter, just waiting and waiting for that one perfect pitch to come right down the middle of the plate.
And really, that's the final question Buffett's strategy leaves us with. You've seen the logic, you get the math, but knowing what to do is one thing. Actually having the discipline to do it, to buy when you feel sick to your stomach and every headline is screaming sell, and to patiently do nothing when it feels like everyone else is getting rich, that's the real test. So, do you have the discipline for the when?
All right, let's talk about a legend. Today, we're cracking open the playbook of none other than Warren Buffett. We're going to trace the incredible evolution of his investment strategy because it's a fascinating story of discipline, smarts, and learning from the past to build something truly genius.
You've probably heard this quote a million times, right? But it is so much more than just a clever little catchphrase. Honestly, it's the master key. It's the DNA for his entire philosophy. It sounds so simple, but actually living by this rule is one of the hardest things in the world for an investor to do.
So the big question is, how did he do it? How did this one idea become the foundation of a massive fortune? Because, his strategy wasn't just born overnight. Nope, it was forged in the fire of market booms and some absolutely devastating crashes. It's a journey from a good strategy to a truly legendary one.
At its very heart, Buffett's whole method comes down to this, the Buffett paradox. It means doing the exact opposite of what 99% of other investors are doing. When the entire world zags, he zigs. It's that simple and that profound. Think about it. Picture this. The market's on fire, right? Everyone's celebrating, watching their accounts go through the roof, and making what feels like easy money. And what's Buffett doing?
He's the guy in the corner quietly selling his shares and just building this huge mountain of cash. And the media? Oh, they jump all over him. They say he's lost his touch, he's over the hill. But then, boom, the party always ends. The market crashes, and panic fills the streets. And who's there, totally calm and ready to go shopping? Warren Buffett. With that giant pile of cash, he gets to buy the best companies in the world at a massive discount. This is his cycle of genius. And to really get where it came from, we've got to go back to the guy who taught him.
You see, Buffett didn't just invent this stuff out of thin air. He had a master, the one and only Benjamin Graham, who is literally the father of value investing. Graham's ideas will be the bedrock of Buffett's entire early career, but they were ideas born from some serious financial trauma. I mean, just look at this number, 88%. During the Great Depression, the market wasn't just down, it was annihilated. 88% of its value, just gone. It was so bad that Dow didn't get back to its 1929 peak for another 24 years. An experience like that, it changes you. It taught Graham one thing above all else. You have to protect yourself from losing big.
So after living through that disaster, Graham developed this, let's call it a gritty strategy. Buffett famously named it the cigar butt approach. The idea is you walk down the street, find a discarded cigar butt that has one last puff left in it. You pick it up, get a free puff, and then you throw it away. You're buying mediocre companies for way less than they're worth just to squeeze out that last little bit of profit. And man, for years, this worked like a charm for Buffett. In the 50s and 60s, he was the king of this strategy, digging through financial reports to find these little bargain companies. And it made him and his investors very, very rich. But, and this is a big but, he was about to learn a lesson that would change everything, something even his master hadn't fully grasped. Okay, fast forward to the late 1960s. The vibe is electric. The market's a wild party again. Stocks are hitting insane highs. But Buffett, being a student of history, gets this terrible sense of déjà vu. He sees a bubble forming, and he knows exactly how this story ends. And this is the key. He remembered that even his own brilliant mentor, Ben Graham, got swept up in the roaring 20s and lost a ton of money. Buffett said to himself, nope, I'm not making that same mistake. So he did something that made everyone in the investment world think he was completely crazy.
Just look at this timeline. This is where you see his almost superhuman discipline. In 1969, at the height of the party, he closes up shop, sells everything. Then, for 3 long years, he just sat on his hands, watching everybody else get richer and richer. He just waited. And then, in 1973, just as he predicted, the whole thing came crashing down. And the 73 crash was no joke. Now, it wasn't the Great Depression, but the market still lost 45% of its value. That's brutal. It crushed people. Even his own partner, the brilliant Charlie Munger, saw his fund lose more than half its value. But for Buffett, oh man, for the guy sitting on a mountain of cash, this wasn't a crisis. It was the sale of the century. His famous quote about it tells you everything you need to know about his mindset. While everyone else was panicking, he was ecstatic about the opportunities. And this was the moment. This was the turning point where his strategy evolved. The light bulb went on, and he realized just finding cheap stuff, these cigar butts, wasn't enough. It was time to level up. He wasn't just looking for bargains anymore. He was looking for greatness. He realized that old strategy was all about finding disposable deals. They were okay businesses at best, but they were pretty lousy long-term investments. You'd get your one puff of profit, sure, but then you're right back out on the street, searching for another one. It's exhausting. So he pivoted. Instead of cigar butts, he started hunting for companies with what he calls a durable competitive advantage. Think of it like a castle with a giant moat around it protecting it from invaders. He wanted to buy the whole castle, something you could own for decades and just watch it grow and compound your wealth. And boy, did it pay off. His investment in the Washington Post is the absolute poster child for this new strategy. He swooped in during the 73 crash, bought this amazing, high-quality business for pennies on the dollar. And the result? Just look at that number, a mind-blowing 5,500% return. Let's break that down. He put in $11 million. Over time, that investment grew to be worth over $600 million. You see the difference? That is not a one-puff cigar butt.
That's the power of buying a truly fantastic company at a moment of peak fear and just holding on. All right, let's jump in the time machine and go forward a few decades. Buffett's got a strategy perfected now. And then comes 2008, the big one, the global financial crisis. And it was like history was rhyming all over again. And can you guess the pattern? Yup, in 2007, the market was euphoric. And what was Buffett doing? Patiently letting his cash pile up. We're talking $37 billion. And you guessed it, the so-called experts on Wall Street were saying he was washed up again. But when the bottom fell out of the global economy, when the entire financial world was on fire, who did they call? The man with the fire hose full of cash. He was basically the lender of last resort for America, making the deals of a lifetime and saving iconic companies, while securing incredible terms for Berkshire Hathaway. So after all this history, all this evolution, what's the secret sauce? Well, you can actually boil down his entire perfected playbook into a surprisingly simple model. It's almost deceptively simple. Here it is, the Buffett model. Step 1, be patient. Let your cash build up when everyone else is greedy. Step 2, do your homework. Find wonderful businesses. Step 3, wait for the panic. And step 4, when everyone is screaming sell, you start buying and you hold. The strategy itself is simple, but actually doing it, that's incredibly difficult. And this right here, this is the whole ball game. The typical investor is market sensitive. They follow the herd. Prices go up, they buy. Prices go down, they panic and sell at the worst possible time. Buffett is price sensitive. He could not care less what the herd is doing. He only cares about one thing. Is this great company on sale? It's a battle against our most basic human instincts. And really, that's the ultimate takeaway here. Understanding what to do is the easy part. The real genius of Warren Buffett is having the psychological strength, the discipline to actually do it, to sit on your hands while your friends get rich, and to run toward the fire when everyone else is running away. That is what makes a legend. You know, we live in a world that is just completely obsessed with disruption, right? The next big thing, the next unicorn. So today, we're going to dive into one of Warren Buffett's most powerful and honestly kind of radical investment secrets, why he absolutely loves companies that are, well, old. It's a strategy that just flies in the face of everything you hear about innovation, but it is the key to his incredible success. All right, so here's the game plan. We'll kick things off with a really simple but profound idea he calls the chewing gum test. Then we'll see this whole theory in action by taking a peek at his actual portfolio. After that, we'll really dig into the core predictability principle that drives his decisions, compare the so-called boring with the groundbreaking, and wrap it all up by exploring what it really means to invest for forever. So at the very heart of Buffett's strategy, it's not some complicated algorithm or a secret Wall Street formula. Nope, it's a simple, really memorable test. It's a little thought experiment that basically reveals his entire investment mindset, and it's something anyone can use. It all starts right here. You see, while most investors are out there chasing the next big thing, trying to guess what the world's going to look like way down the road, Buffett is playing a totally different game. He's not trying to predict change. He's actively looking for the absence of it. He wants to find those little pockets of the economy that are just immune to the constant march of progress. And this right here is the chewing gum test in a nutshell. Can you find a product that is so fundamental, so baked into human habit, that even a world-changing invention like the internet won't mess with its core business? That is the kind of rock-solid stability he's looking for. It's really a search for certainty in a very, very uncertain world. And listen, this isn't just some clever little saying he trots out. No, this is the absolute foundation of his entire portfolio. This way of thinking is what decides where he puts his billions. And the proof? It's right there in the companies he actually goes out and buys. I mean, just look at how old these businesses are. We're not talking about companies that are a decade or two old. These are institutions that have survived world wars, the Great Depression, and countless tech revolutions. They've proven, just by surviving, that their business model is incredibly tough. They're kind of like commercial fossils, still living and breathing. His portfolio is basically a who's who of brands our great-grandparents would recognize. Kraft has been making cheese since 1903. The Oreo, a bestseller since 1912. And get this, even his newer investments, companies like Walmart and Costco, are now established middle-aged giants themselves. This is no accident. It's a very deliberate pattern of investing in proven staying power. So what's the deal with this obsession with age? It's not about nostalgia. It all boils down to a powerful and really a surprisingly simple financial formula that sits under his entire strategy. It reveals exactly why, for him, old is gold. This is the whole game right here. A product that barely changes from one decade to the next, well, that creates an earnings stream that is steady, reliable, and, this is the crucial part for an investor, predictable. In a world that's so volatile, predictability is the ultimate currency. It just strips away a massive layer of uncertainty and risk from the whole investment equation. For Buffett, a long history is like the ultimate stress test. I mean, if a company has been successfully selling the same thing for over half a century, that's a huge sign that the business has something special going on. It means competitors have tried and failed to break its hold on the market for generations. And that something special has a name, a durable competitive advantage. It's that powerful brand, that secret formula, or that distribution network that other companies just can't copy. It's like a castle with a giant moat around it. And Buffett thinks the easiest place to find these untouchable castles isn't in the fast-changing world of tech, but in the slow, stable industries that have proven their dominance for decades. Okay, to really hammer this point home, let's put two totally different kinds of companies side by side. This contrast makes everything crystal clear, and it really shows the hidden dangers of just chasing innovation. So on one side, you've got the beautiful simplicity of Coca-Cola. They've been selling the same sugary brown water for over a century. Their research budget is tiny. Now compare that to a company like Intel. Just to stay alive, Intel has to spend billions every single year on R&D and new factories. Also, their products aren't totally obsolete in 3 years. One model just generates cash. The other one eats cash at a terrifying rate just to stay in the race. And that right there, that perfectly explains why Buffett has famously avoided so many tech stocks, no matter how exciting they seem. The pace of change is just too fast. In the world of computers and software, the road ahead is always foggy and uncertain, and if Buffett can't see the destination clearly, he refuses to even get in the car. So at the end of the day, this strategy isn't about being old-fashioned or being afraid of the future. It's about making a really smart, calculated bet on the parts of human nature that are timeless. The habits, the tastes, and the desires that just don't really change. This question really gets to the heart of everything. So forget the balance sheets, forget the earnings projections for just a second, and just think about this. It turns a complex financial idea into something we can all just get. So what's your gut answer? He is making a massive, multi-billion-dollar financial bet that this simple childhood ritual is going to endure. He's betting that this small pleasure will keep generating predictable profits for Kraft for decades and decades to come, long after today's hottest apps and technologies are just forgotten footnotes in history. All right, so to sum it all up, here is the Buffett method in 5 easy steps. First, look for predictability over glamour and hype. Second, use a product's long history as your guide to its stability. Third, always remember that stability is the engine that creates predictable profits. Fourth, be super aware of the hidden costs and the massive risks of those high-change industries. And finally, put your money behind the things that truly last. And that kind of leaves us with one last provocative thought to chew on. As pretty much everyone else is scrambling to predict the future, to find that next revolutionary company, maybe the smartest and the most profitable move of all is to simply identify the certainties of right now and invest in them for the long haul. Hey, welcome back. When you think about legendary investors like Warren Buffett, you have to wonder, how do they spot those truly great companies, the ones that just keep winning year after year for decades? Well, I'll tell you, it's not some kind of magic trick. It's about finding a very specific clue that's hidden in plain sight. Today, we're going to pull back the curtain on one of Buffett's most powerful principles, the incredible power of consistent earnings. All right, let's jump right in. Here's our game plan. We're going to start with the big problem every investor faces. Then we'll uncover Buffett's secret weapon for solving it. We'll look at some real Hall of Fame companies and see what makes them tick, and then we'll contrast that with some pretty serious cautionary tales. And finally, we'll put them head to head and leave you with a powerful new way to look at any business you're interested in. As an investor, you're just getting hammered with noise every single day. You've got news, stock tips, hype coming from all directions. The real challenge, the real work, is digging through this massive haystack of thousands of public companies to find those rare few that are truly built to last. So that's the million-dollar question, right? How do you actually do it? How do you tell the difference between a company that's just having a good year and one that's a true long-term champion? Well, you can forget about the daily stock chart. According to Buffett, the answer is found somewhere much, much deeper. And this is where things get really interesting because we're going to shift away from all that speculation and get into some real investigation. See, Buffett figured out that a company's past, specifically its financial history, tells an incredibly powerful story. It's not about trying to predict the future with a crystal ball. It's about understanding the deep fundamental strength of a business right now. The grand prize, the thing we're searching for, is what Buffett famously calls a durable competitive advantage. Just picture a castle with a huge, deep moat around it. That moat protects the castle from invaders. Well, in business, that's what this advantage does. It's a special quality that protects a company's profits from being stolen by competitors. But how on earth can you actually see a moat like that? And bam, here it is. The clue. The clearest, most dependable sign of that protective moat is right there in the earnings history. You're looking for a company that doesn't just make money, but one that shows a consistent, strong, upward trend over a long period of time, say, a decade. This isn't just a number, it's a window into the true economic engine of the business. So let's see what this actually looks like in the real world. We're going to take a look at the 11-year earnings histories of 3 companies that Buffett himself has pointed to as having this exact kind of advantage. Think of these as our Hall of Famers. First up, Procter & Gamble. Just follow the earnings per share, that's EPS, from 2001 all the way to 2011. It starts at $1.56, and it just climbs and climbs almost every single year. You see those tiny little dips in 09 and 10? That's barely even a stumble. The overall direction is unmistakable. It is powerfully up, finishing out at almost $4 a share. So what does that all add up to? A massive 155% increase in earnings per share. That's not just a number on a page. That's the real financial result of selling things people buy over and over again, like Tide and Crest, reliably and profitably, all around the globe. It's the engine of a great business, made visible. Okay, here's another classic, Coca-Cola. And you see the exact same powerful pattern. It starts at $1.60 in 2001, and those earnings just march steadily upward, finishing at $3.85. The source material called this a bubbling upward trend, which is just perfect. It's predictable, it's consistent, and man, is it strong. And over that decade, you're looking at a 140% increase in earnings per share. This is what a world-class brand with a gigantic economic moat looks like on a spreadsheet. It's just the pure power of selling a simple, beloved product to billions of people day in and day out. And for our final Hall of Famer, check this out, Johnson & Johnson. Honestly, this one might be the most impressive of all. Just let your eyes trace the numbers from 2001 right through to 2011. What do you notice? There isn't a single down year, not one. Every single year, their earnings per share went up. That is an incredibly solid and powerful trend. And it all adds up to this, a 154% increase. This represents a full decade of just unwavering, profitable growth. This is the financial fingerprint of a business with a truly durable competitive advantage, built on products that people need whether times are good or bad. Okay, now let's flip the coin completely. Because to really understand how special that kind of consistency is, you have to see what the opposite looks like. We're going to look at companies in super competitive commodity-type industries. Businesses that are stuck with huge costs and brutal price wars, which makes it almost impossible to build that protective moat. Their earnings histories tell a very, very different story. First, let's look at the airline industry with United Continental. Airlines are the classic example of this. They basically compete on price and nothing else. And, whoa, this is the result. Just look at those staggering losses in the first few years, losing over $33 a share in 2001, then another $34 in 2002. Those few profitable years there at the end, they're completely drowned in an ocean of red ink. This is the definition of erratic. Just let that number sink in for a second. Over this period, the net result for a shareholder was a loss of over $107 per share. As the source material puts it, this is an earnings history you might wish on your worst enemy. It's a machine for destroying money. Next up, Ford Motor Company. The auto industry is another one of these incredibly tough, capital-intensive businesses. And you can see some profitable years in there, right? In the early 2000s, things looked okay. But then, bam, they get completely swallowed up by these massive losses in 2006, 07, and 08. There's just no consistent upward trend. It's a wild, unpredictable ride that depends entirely on the economy. And the 10-year total? A loss of over $10 per share. Now, it's not the complete catastrophe we saw with United, but this is definitely not the kind of history that builds long-term wealth for anyone. It's basically a decade of spinning your wheels and going nowhere. Finally, let's jump into the high-tech space with the chipmaker AMD. This whole sector is famous for its boom and bust cycles, right? Where products need constant, crazy expensive upgrades just to stay in the game. And you can see that story right here in the numbers. In this 11-year stretch, AMD had 6 years of losses. Those 5 years they did make a profit, they're all over the place and totally overshadowed by the negatives.
The final score for the decade is a loss of almost $12 per share. This is the financial reality of being locked in a constant, high-stakes war for tech supremacy against really fierce competitors. It's just incredibly difficult to build a lasting advantage.
Okay, so to really drive this point home and make the contrast crystal clear, let's put one company from each team, the absolute best and the absolute worst, side by side for a final showdown. And wow, this slide just says it all, doesn't it? On the left, you've got Johnson & Johnson's steady, predictable, wealth-creating machine. Over this period, it generated over $40 in total earnings for every single share. And on the right, you have United Continental's volatile, value-destroying business, which lost over $107 per share. I mean, the difference is literally night and day.
So what's the big lesson here? What do we take away from all this? Well, this isn't just some history lesson. This idea of earnings consistency is a simple but really powerful lens that you can now use. It helps you cut through all the noise and hype and lets you see the fundamental economic reality of any business. Which brings us to a final question for you. Pick a company you follow, one you own, or just one you admire. Go look up its 10-year earnings history. For just a minute, ignore the stock price and just look at the numbers. Does its story look more like one of our Hall of Famers, or does it look like one of our cautionary tales? The answer might just tell you everything you really need to know.
What if I told you that you could get the rock-solid safety of a bond, but with the massive growth potential of a stock? I know, it sounds almost too good to be true, right? But this is the absolute core of a powerful mental model from, you guessed it, one of the greatest investors of all time, Warren Buffett. Today, we're going to break down his equity bond concept, and trust me, it's a framework that will completely change how you look at investing.
You know, every investor, from a beginner to a pro, faces this classic choice. Over here, you've got bonds. Think of a bond as a really reliable IOU. You lend a company or a government your money, and they promise to pay you a fixed interest, that coupon, every single year. It's predictable, it's safe. Then over here, you have stocks. They're a piece of the business, so their earnings can go up and down, which makes their prices, well, they bounce around a lot. It's always been this classic trade-off. Do you want safety, or do you want the chance for some serious growth? But this is where things get really interesting. What if that whole trade-off was a false choice? What if you didn't have to pick one or the other? Is there a way to find an investment that gives you the certainty of a bond, but with a payout that isn't stuck in place? A payout that actually gets bigger over time? Asking this question, well, that unlocks a whole new level of thinking about value. All right, so here's our game plan for unpacking this brilliant idea. First, we're going to challenge the very idea of what a bond is. Then, we'll introduce Buffett's equity bond and show you the super simple math behind it. After that, we get to the fun part, the magic of growth. We'll prove it works with an absolutely legendary real-world example, Coca-Cola. And then we'll wrap up with the key mindset you have to adopt to make this all work for you. So, let's just start there. A bond that grows? I mean, how is that even possible? It seems to break the #1 rule of what a bond is. The answer isn't in some complicated financial product. It's all in a mental shift. See, Warren Buffett realized that if a company is truly excellent, if it's strong enough, its stock stops acting like a volatile lottery ticket and starts behaving like something much more predictable, a special kind of bond he calls the equity bond. And here it is, the core idea. You find a company that has a deep, long-lasting competitive advantage, what investors love to call a moat. Think of it like a fortress around their profits. It could be a brand everyone trusts, a critical patent, anything that keeps competitors at bay. This moat makes its earnings so consistent, so predictable, that they start to feel just like a bond's coupon payments. But, and this is the kicker, unlike a normal bond, these payments can actually grow year after year. And look, this isn't just my interpretation. This quote right here captures the entire idea in his own words. The secret ingredient, the magic phrase, is durable competitive advantage. That's the engine that pumps out those predictable earnings and allows someone like Buffett to see the reliability of a bond where everybody else just sees the chaos of the stock market.
So this all sounds fantastic in theory, right? But how do we actually put some numbers on it? How do you figure out the interest rate, or what we'll call the initial return, on one of these equity bonds? Let's walk through a really simple hypothetical example.
First things first, we got to look at the profits. With this way of thinking, the company's annual after-tax earnings per share is your coupon payment. So, for our little example here, let's just say our company is earning a solid $8 for every share out there.
Okay, so we've got our $8 coupon, but now we have to actually go out and buy this equity bond. And you and I, we can't just call up the company and buy a share for its paper value. We have to go to the stock market. And fantastic businesses, well, they usually sell for a premium. So let's say the price tag to buy one share, our entry ticket for this bond, is $150.
So the math here is actually incredibly simple. Your initial return is just the earnings divided by the price you paid. That's our $8 in earnings divided by our $150 purchase price, and boom, that gives us an initial return of 5.3%. You can just think of this as the starting yield on our amazing new equity bond.
Now, I know what you might be thinking. 5.3%? I mean, that's okay, right? You could probably find a regular, boring old bond that pays that. But hold on. This is just the starting point. This is where the equity bond starts to show its superpowers and leaves a normal bond completely in the dust. Remember, the whole reason we chose this company was because it has that durable competitive advantage, that moat. This means it's not some static, boring business. Its earnings are growing year after year after year. So let's assume it can grow its earnings by a healthy 10% annually. This is the magic ingredient because it means your $8 coupon isn't fixed. It's getting a raise every single year. And this is just so cool. Look at how this expanding equity bond works over time. You paid that $150 one time. That's it. In year one, sure, your return on that money was 5.3%. But because the business is growing its earnings by 10% a year, 10 years down the road, that same company is now earning almost $21 per share. And since you still only paid $150 way back when, your personal rate of return on your original money has exploded to 13.8% annually. Your yield just keeps getting bigger and bigger. All right, this is a great thought experiment. It makes perfect sense on a slide. But did this ever actually, work in the real world? With billions of dollars at stake? You bet it did. Let's look at one of the most iconic investments ever made.
So we're going to hop in the time machine and set the dial for 1988. This is the year Warren Buffett, through Berkshire Hathaway, decided to bet big, really big, on the Coca-Cola company. And you have to understand, he wasn't just buying a stock. In his mind, he was buying an equity bond.
So let's look at the raw numbers. Back in '88, Berkshire was paying about $5.22 per share for Coke. At that exact moment, Coke was earning 36 cents per share. So Buffett does the simple math, and he sees his initial coupon, his starting yield, is a pretty respectable 6.8%. But he knew Coke had one of the biggest moats in the world, that brand, that distribution network, and he bet those earnings would grow. And boy, did they ever. Fast forward to 2011, and those earnings had skyrocketed from 36 cents to $3.85 per share. So what did all that earnings growth do to his original investment? Well, by 2011, the return he was getting on that original $5.22 was a mind-blowing 1,145%. That works out to a compounding return of over 11.5% a year every year for 23 years straight. That's consistently beating the market. This wasn't some lucky gamble. This was the equity bond thesis playing out perfectly on a massive scale.
So what's the big lesson here? What's the main thing we should all take away from this incredible concept? It really boils down to a complete and total shift in how you view your investments and even the stock market itself.
The most crucial part is this. You have to stop watching the daily, the weekly, even the yearly zigs and zags of the stock price. Stop worrying about it. Instead, you focus like a laser on one single thing. Are the economics of the business getting better? Is that coupon, the company's power to earn money, getting bigger over time? If the answer is yes, then all the rest is just noise.
And Buffett absolutely lives and breathes this. He has said over and over that he doesn't care if the stock price goes down in the short term. In fact, he kind of likes it,
because it means his favorite businesses are on sale. He has absolute confidence that, eventually, the market will wake up and the stock price will catch up to the real, growing value of the company.
And that leaves us with a really powerful question to think about. If you take this equity bond framework and apply it to the world today, which companies out there have that fortress, that deep, durable competitive advantage that could make them the next Coca-Cola over the next 20 years? That, right there, is the billion-dollar question. Thanks for joining this explainer.
You ever look at a stock and wonder, how do the pros actually figure out if it's a buy for the long haul? Well, it's not about crystal balls or just pure gut feelings. There's a powerful, structured method we're going to break down today. And by the end of this, you're going to have a brand new tool in your investing arsenal to project a company's future value.
This is the big question, right? And answering it is where the real work of investing kicks in. It's what separates thoughtful analysis from just, guessing. We're going to show you a step-by-step method to turn this huge, daunting question into a manageable, logical analysis. Okay, let's get into it.
All right, so here's our game plan for cracking this nut. We'll start with a real-world company, then we're going to dig into its past numbers to find its growth engine. From there, we'll project that into the future and figure out what that means for your wallet. And definitely stick around for the end, because we've got a crucial warning you do not want to miss.
To make all this real, we're not just going to talk theory. We're actually going to hop in a little time machine and travel back to 2011 to analyze a company you definitely know. This isn't some made-up exercise. We're using the actual financial data from that time to see how this method would have played out in the real world.
Okay, picture this. The year is 2011. The company is Coca-Cola, an absolute classic, and is trading for about $65 a share. You're an investor, standing right there, looking 10 years into the future. Is this a great deal or a total dud? That's the exact question we're going to answer using the numbers they had back then.
So how in the world do you start trying to predict the future? Well, funnily enough, you start by looking backward. To get a glimpse of where a company might be going, you first have to understand where it's been. Let's dive into Coca-Cola's history to find the clues.
Okay, so what you're looking at here is Coca-Cola's earnings per share, or EPS, from 2001 all the way to 2011. This is our key number, and it's a favorite of investing legends for a really good reason. It cuts through all the noise and shows you exactly how much profit the company is making for each share of its stock. This data right here is the foundation for everything we're about to do.
So just take a second and look at these numbers. What do they tell you? You don't have to be a math whiz. Just let your eyes scan down that column. See that? It's a pretty steady climb upwards, right? There's no drama here, no crazy dips, no years with big losses. Just solid, consistent performance. This is exactly the kind of stability that makes a company a good candidate for this type of analysis.
So we've seen that it's been growing consistently. Now we need to find out how fast. An upward trend is great, but we need to turn that trend into a number. We're going to distill that entire decade of performance into one single powerful figure that's going to be the engine for our whole projection. Let's get that annual growth rate. Now, to get this rate, we just need three simple things: a starting point, an ending point, and how long it took to get from A to B. It's kind of like calculating your average speed on a road trip, but for a company's earnings. And don't worry, any simple online financial calculator can do all the heavy lifting for us.
So for our Coca-Cola example, here are the numbers. Our starting point, the present value, is the EPS from 2001, $1.60. Our end point, the future value, is the 2011 EPS of $3.85. And the time between them is, of course, 10 years. Let's plug these in and see what we get.
And bam, there it is, 9.18%. That is the magic number. This is Coca-Cola's compound annual growth rate over that decade. And this isn't just some random statistic. It's a measure of the business's actual momentum. Remember this number because it is the absolute key to unlocking our future projection.
Okay, now for the really fun part. We've built our historical growth engine. Now it's time to fire it up and see where it takes us over the next 10 years. Let's project what Coca-Cola's earnings could look like way out in the year 2021.
We're making a simple but really powerful assumption here. What if Coca-Cola can just keep up that same 9.18% growth rate for another 10 years? So we take our 2011 starting earnings of $3.85 and just let it compound at that rate for a decade. Let's see what happens.
And thanks to the magic of compounding, our projection shows Coca-Cola could be earning $9.27 per share by 2021. Wow, That's more than double where we started. But hold on, that's earnings. What does that mean for the stock price? That's our next question.
To answer that, we need a bridge to get from earnings to a stock price. And that bridge is called the price-to-earnings, or PE ratio. It might sound complicated, but it's really not. It's just a simple way to see how much the market is willing to pay for each dollar of a company's profits. Think of it as the price tag for a company's earnings. Now, what PE should we use? This is a super important step. We could use a really high PE from when the market's booming, but that's like building our projection on a house of cards. It's optimistic, but it's fragile. A much safer, smarter bet is to use the lowest PE ratio the stock traded at over the past decade. For Coca-Cola, that was about 16. This conservative approach gives us a built-in margin of safety. It's way better to be pleasantly surprised than horribly disappointed, right? So now we just put it all together. We take our projected earnings of $9.27, multiply it by our conservative PE of 16, and we get a potential stock price of $148.32 in 2021. Now that's a big jump from our starting price of 65 bucks.
We've gone from the past to the future, from earnings to a potential stock price. Now it is time to answer the big question. What kind of return could we actually expect from our investment? What does this all mean in terms of a simple annual percentage? Let's find out.
We're going to run our rate of return calculation one more time. But this time, our starting price of $65 is the present value, and our projected future price of $148.32 is the future value, all over that same 10-year period.
And the result is a projected annual return of 8.6%. That's a solid number. As an investor back in 2011, you'd have to ask yourself if that meets your goals. But is that the whole story? For a company like Coca-Cola, there's another piece of the puzzle we absolutely need to consider.
Yeah, we've only looked at how much the stock price could go up, but what about the cash that Coca-Cola pays out directly to its shareholders every single year? Let's add dividends to our calculation and see how much that changes things.
In 2011, Coca-Cola's dividend was about $1.88 per share. So let's assume, just to be conservative, that it just stays the same for 10 years. That's still an extra $18.80 in our pocket. When we add that to our projected stock price, our total future value is now $167.12.
And with those dividends included, our projected annual return jumps from 8.6% all the way to 9.9%. Now that's a big difference, and it brilliantly shows why you should never, ever forget about dividends when you're analyzing a stock. They are a real and powerful part of the total return.
And now, for what is probably the most important takeaway of this entire explainer. This method is a powerful tool, but it is not a one-size-fits-all solution. It only works for companies with a proven, multi-decade track record of consistent earnings and a strong competitive advantage, what investors call a moat that protects it from competition. Using this method on a volatile company is a recipe for disaster. So the ultimate takeaway? This is a powerful tool, but you have to use it wisely and only on the right kind of businesses.
All right, today we are diving into something really cool, what some people call Warren Buffett's consumer monopoly test. It's a surprisingly simple but incredibly powerful way to see if a company has a real, lasting advantage. So what if I told you that there's just one number hiding in plain sight in any company's annual report that can give you this massive clue? A clue that points to whether a business has a real, durable edge over everyone else. It sounds almost too simple, but the insight it gives you, well, it's huge.
And you guessed it, the master who's been using this for decades is none other than Warren Buffett himself. He uses this as a quick check, a way to gauge the real economic story of a business over the long haul. And today, we're going to walk through exactly how he does it. Okay, so here's what we've got on tap. First, we'll uncover this hidden clue. Then, we'll decode the number at the heart of it all. After that, we'll get into the real secret, the Buffett tracking method. We'll even see it in action with a dramatic showdown between two companies. And finally, we'll talk about how to use this powerful but not quite perfect tool. So, what is this magic number? You know, we're always told to look at the flashy stuff, right? Earnings, revenue, the stock price. But Buffett tells us to look somewhere else, somewhere a little less exciting, buried deep inside a company's financial statements. The entire foundation for this whole thing is a little something called book value. Now hang on, don't let the accounting jargon throw you. It's way more straightforward than it sounds, and once you get it, you've got the key to this whole method. Let's break it down. So book value per share, it's pretty much exactly what it says on the tin. It's the value of the company's equity broken down to a per share basis. A simple way to think about it is if a company were to sell off everything it owns and pay back everything it owes, this is what would be left over for the shareholders. And the math behind it is beautifully simple. Seriously, you just take all the stuff the company owns, that's its assets, then you subtract all the stuff it owes, those are its liabilities. What's left over is the company's equity. Then you just divide that equity by the number of shares out there and boom, you've got the book value per share. Okay, but here's the kicker. This is where the real Buffett magic happens. Because he doesn't just look at that number and call it a day. That's not the secret at all. The real genius is in how he watches it over time. First, we got to get one thing straight. There's book value, and then there's what we're really after, intrinsic value. Book value is just an accounting number. It's a snapshot of the past. But intrinsic value, that's the holy grail. It's what the business is truly worth based on all the money it's going to make in the future. And you have to remember, these two numbers are almost never the same.
And this is where it all clicks into place, straight from the man himself. See what he's saying here? He's not saying book value is intrinsic value. He's saying it's a rough tracking measure. He's not looking for the numbers to be equal. He's looking to see if the growth in book value is moving in the same direction as the growth in the company's real underlying worth. So let's nail this down. The secret isn't finding a high book value. The secret is finding consistent, long-term growth in that number. A company that can reliably grow its book value year in and year out is probably a company that's also growing its true intrinsic value. And that's the sign of a really powerful business.
All right, enough with the theory. Let's see this thing in action, right? We're going to pit two legendary companies against each other over a 16-year period and just let the numbers do the talking.
In this corner, we've got Coca-Cola, a textbook example of a brand powerhouse, what Buffett might call a consumer monopoly. And in the other corner, Ford Motor Company, an industrial giant in a brutal, super competitive industry. We're going to track their book value per share from $195 all the way to 2011.
First up, Coca-Cola. Get ready for this. Over that 16-year stretch, its per-share book value grew by an incredible 579%. That is some serious, steady compounding at almost 13% a year. That number alone tells you a heck of a story.
But look closer. It's not just the final number. It's the consistency. See that? It just keeps going up. From a little over $2 a share in '95, it's a steady, relentless climb to over $14. This is what a durable competitive advantage looks like in black and white, a business that just keeps growing its underlying value. Okay, now for Ford, same exact time period, and, well, the story is the complete opposite. We're not talking about slow growth, we're talking about a collapse. Book value per share went down by over 86%.
And here's the flip side. What's wild is that Ford actually started out with a much higher book value than Coke, over $21. But look at that journey. It's choppy, unpredictable, and ultimately the trend is just undeniably down. It's a clear signal of a business in a really tough industry that was actually shrinking its underlying equity base over time.
I mean, the picture couldn't be clearer, right? By tracking just this one simple number, we see two totally different stories. Coca-Cola was a business that was getting richer and stronger. Ford was a business that was getting poorer and weaker, at least in terms of its equity.
Now, I know what you're thinking. This looks way too easy. And that's why we have to talk about the fine print. This is an amazing indicator, but it is not a magic bullet. There are definitely a few things you have to watch out for.
So here's how you should think about this. It's like a powerful scanner. It's a fantastic first step for sorting through thousands of companies to find the ones that might be special. But it's just that, a start. It's not the finish line.
For example, the numbers can sometimes fool you. A company could sell off a big, profitable part of its business. On paper, its book value shrinks, but that could actually be a brilliant move. Or on the flip side, a company could go out and buy another company for a ridiculous price. That would make its book value go up, but they actually destroyed real value in the process. So the real takeaway here is to use this test, this idea of long-term book value growth, to find your starting lineup. When you find a chart that looks like Coca-Cola's, you know you're onto something, and it's time to roll up your sleeves and figure out why the numbers look so good. And that really brings us to the end. You now have this incredibly powerful yet simple tool used by one of the greatest investors to ever live to spot potentially amazing businesses. So the only question left is, what companies are you going to look at first?
Welcome to The Explainer. Today, we're going to pull back the curtain on one of the greatest investment stories you'll ever hear. Warren Buffett's huge, long-standing, multi-billion-dollar bet on American Express. Take a look at this number, $5.5 billion. By 2011, this was the profit Berkshire Hathaway had sitting on the books from its American Express investment. And a number like that, well, it just makes you ask.
So that's what we're doing today. We are diving right into the mind of Warren Buffett. We're going to break down the business, the incredible history, and the simple but totally brilliant math behind one of his most legendary investments.
All right, so here's how we're going to tackle this. First, we'll look at the size of the bet itself. Then we'll get into the company's secret weapon, its really fascinating history, and Buffett's strategy of buying when there's blood in the streets. We'll also see how it actually profits from inflation, and then at the end, we're going to run the numbers just like he would.
Okay, let's get into it. You know, to really get why this is such a big deal, you first have to appreciate the sheer scale of the investment. We're not talking about a small position here.
So by 2011, Berkshire had piled up over 151 million shares. That gave them a 12.6% stake in the entire company. They spent about $1.3 billion to get it, and by that year, that stake had ballooned to be worth almost $7 billion. You see, this was never just some casual stock pick. This was a massive, high-conviction bet on a business that Buffett knew inside and out.
And now we get to the really good stuff, the why. Why did Buffett love this business so much? It all comes down to a really fundamental difference in how American Express actually makes its money. It's a key advantage that makes it so much more profitable than its competition.
And this right here, this lays it all out. When you swipe a Visa or a MasterCard, you've got three different players splitting a fee of, say, 1.9%. You've got the bank that gave you the card, the bank that handles the transaction for the store, and then the network itself. But American Express, well, American Express is all three of those things. It's the issuer, the acquirer, and the network. This closed loop means they keep the whole fee for themselves, and that fee is also higher, sitting around 2.5%. Believe me, that is a much, much better business to be in.
So you might be thinking, okay, why would any merchant pay that higher fee? And the answer is all about the incredible power of the American Express brand. To really get that, we have to go way back, because this company was a trusted name in money long before anyone had even thought of a charge card.
I mean, they started way back in 1850 as basically a high-end delivery service. Then they got into the mail-order money business. The whole time they were building a reputation for trust and for solving people's financial headaches. And all that history led to the invention of the traveler's check in 1888, a game-changing product that introduced a financial concept that is just pure genius.
And that concept is called float. Think about it. When you bought traveler's checks, you gave Amex your cash right then and there. But you might not actually spend that money for weeks or even months. Well, in all that time, American Express gets to use your money for free. It's basically a giant zero-interest loan from millions of customers that the company could then go and invest for its own profit. And if there's one thing Warren Buffett loves, it's float.
Okay, so you hear all this, and you probably think Buffett just bought into this perfect, unstoppable company, right? Wrong. The reality is the complete opposite. His biggest, boldest moves into American Express came when the company was in very, very deep trouble.
Back in the 1960s, a total disaster hit. It was called the Great Salad Oil Scandal. A big borrower defaulted, and the collateral for the loan, these giant tanks supposedly full of salad oil, turned out to be, well, mostly water. The losses were so huge they almost wiped out the company's entire net worth. The stock just cratered, falling from over $80 a share all the way down to 30.
But this is where the genius of Buffett really shines through. He looked right past the screaming headlines and the panic in the market. He realized the scandal was a horrible, one-time event, but the actual businesses, that powerful brand, the loyalty of card members, the traveler's check machine, they were totally fine. In fact, they were still incredibly profitable.
So what did he do? He bet the farm. He poured 40% of his entire fund into the stock, and of course, made an absolute fortune as it recovered. He basically proved his now famous philosophy: the absolute best time to buy a wonderful business is when it's stuck with a temporary problem that has scared everybody else away.
And wouldn't you know it, a few decades later, it was like déjà vu. In the early 90s, another crisis hit.
This time, it was a failing brokerage division called Shearson Lehman that was just bleeding money and dragging the whole company down with it. And Buffett saw the exact same setup. A single, ugly part of the business was hiding the incredible strength for the core charge card franchise. He invested heavily. Again, betting that as soon as they got rid of that problem part, the true value would pop right back to the surface.
Okay, now for a really cool insight, something a lot of people just completely miss. American Express is one of those rare, special businesses that actually gets stronger because of inflation. It has this automatic growth engine, just built right into its DNA, that's tied to rising prices.
Let me just walk you through this. It's pretty simple. Imagine a store sells $100 million worth of stuff back in 1975. Amex gets its 2.5% fee, which is $2.5 million. Easy enough. Now, just fast forward to 2011. Because of inflation, that exact same amount of stuff now costs $400 million. So the store's sales are now $400 million, and Amex's 2.5% fee is now $10 million. Get that? The company is making 4 times the revenue on the exact same volume of goods, and it didn't have to spend a single extra dime on new buildings or equipment. It's just a beautiful economic model.
So we've got a killer business model, a history of bouncing back from disaster, and a built-in hedge against inflation. But how do you actually turn all that into a decision to buy a stock? All right, let's roll up our sleeves and do a quick Buffett-style analysis using the numbers from 2011.
First thing we do is look at the company's earnings per share, or EPS. That's just the total profit divided by all the shares out there. And when you look at this table, yeah, you see that clear dip during the 2009 financial crisis, but the long-term direction is unmistakable. It's up. In fact, over that whole decade, earnings grew at an average clip of 12.2% every single year. That is what a tough, growing business looks like on paper.
Okay, next step. What's our starting return? Well, in 2011, the company earned $4.05 per share, and the stock was trading at about $45. You just divide the earnings by the price, and you get your initial rate of return, a really solid 9%. That's kind of like your day one profit yield on the business.
But here's the thing. The real magic, and this is what separates great investors from everyone else, isn't just that starting 9%. It's what happens next. It's what happens when you take that historical growth rate of 12.2% and you project it out into the future.
If those earnings just keep chugging along and compounding at that same rate, then only 10 years later, the company would be earning over $12 per share. Now just stop and think about that for a second. Your original $45 investment is now being powered by a business earning almost $13 a year for you. That works out to a massive 28.4% annual return based on what you first paid. That is the incredible power of buying a great growing company at a fair price and just letting it work.
So finally, we can put it all together and estimate our total return. If we assume that 10 years down the road, the stock is trading at a pretty normal, conservative valuation, and we add in all the cash dividends they're going to pay you along the way, our total projected annual return from 2011 to 2021 comes out to nearly 14% a year. For a giant, stable, blue-chip company like this, that is an absolutely fantastic potential return.
And really, that brings us to the final question. A potential 14% return year after year was definitely interesting enough for Warren Buffett. And this whole breakdown forces you to ask the same question every smart investor does before they pull the trigger. Based on how good this business is and the price I have to pay for it today, is the potential reward high enough?
Have you ever looked at a move by an investing legend like Warren Buffett and just thought, why? Especially when it seems to fly in the face of everything that's happening in the world? Well, that's exactly what we're going to do today. We are breaking down why, right in the shadow of the 2008 financial meltdown, Berkshire Hathaway sunk millions into the Bank of New York Mellon, a company you've probably heard of, but whose real business is the secret to this whole story. All right, so here's the game plan. First, we're going to unpack that super bold post-crisis bet Buffett made. Then we'll get to the bottom of what BNY Mellon actually is. And trust me, it's not what you're thinking. After that, we'll uncover its powerful, almost hidden competitive advantage, and then we'll crunch the numbers like a true value investor. We'll even project what those returns might look like down the road, and we'll wrap it all up with one big question for you. So, let's get right to the heart of it. The timing of this investment is what's so wild. You have to remember what 2010 and 2011 felt like. The financial world was basically a smoldering crater. Nobody trusted banks, and yet, right in the middle of all that fear, Buffett spots what he thinks is a massive opportunity. I mean, this is the question that had everyone scratching their heads. To most people, banks were toxic. They were radioactive. But to really get the answer, you have to do what Buffett does best. You have to tune out all the noise and all the panic and just look at the simple, fundamental facts of the business itself. And listen, this wasn't just dipping a toe in the water. We're talking about a cool $51 million to snatch up almost 2 million shares. This was a statement. It was a confident stride into a part of the market that pretty much everyone else was running away from, screaming. And this quote right here, this is classic Buffett 101. While everybody else sees a falling stock price and hits the panic button, Buffett sees a sale. He's thinking, great, the business itself is still fantastic, but the price tag just got cheaper. For him, this incredible company was suddenly sitting on the discount rack. Okay, so to really understand why Buffett wasn't scared, you have to get this next part. Because BNY Mellon isn't just another bank. It's a different kind of animal altogether. This really lays it all out. BNY Mellon is not the bank on your street corner. They're not doing car loans or checking accounts. A better way to think of them is like the essential plumbing of the entire global financial system. They're the pipes behind the wall that you never see, but without them, nothing works. They're a bank for other banks. And get this, their history is unbelievable. It was founded by Alexander Hamilton. Yes, that Alexander Hamilton, making it the oldest bank in America. You combine that kind of history with the 2007 merger with Mellon, and you've got the absolute powerhouse it is today. That kind of staying power just screams stability. And just to give you a sense of the scale we're talking about, look at this number, $25 trillion. Let that sink in for a second. That's how much in assets they're holding or administering for other giant institutions. They are, hands down, the biggest in the world at this. They are the trusted caretaker for a massive slice of the world's wealth. And on top of that, they're also actively managing more than $1.2 trillion. Just that piece of their business puts them in the top 10 largest wealth managers on the entire planet. This company is a true heavyweight. And they're everywhere, operating in almost 40 countries, servicing 100 different markets. They are woven into the very fabric of global finance. If you own a mutual fund, an ETF, anything like that, there is a very, very good chance BNY Mellon is the one doing all the complicated, critical grunt work in the background. So all of this scale and this global reach brings us to the next big question for any investor thinking long-term. What's the company's economic moat? What's their secret sauce? What makes it so hard for a competitor to come in and take their lunch money? Well, their moat comes down to this powerful trifecta. Their insane size, all those trillions, gives them massive economies of scale, which pushes their costs way down. You combine that with literally centuries of experience, and you get a business that is, just like it says here, bigger, cheaper, and better than anyone else at what it does. Now, this table, wow, this tells you everything you need to know about how safe their business is. In 2011, a typical bank like Wells Fargo had to put aside $14 billion to cover bad loans. That's almost their entire profit. Now look at BNY Mellon. $30 million. It's less than 1% of their income. They just don't have the same kind of risk. All right, so we get it. The business is a fortress. It's unique. It's got a huge moat. Now comes the fun part. Let's dig into the numbers and see the exact value that Buffett was seeing back in 2011. So first, just look at this chart of its book value per share. I mean, look at that. It's just a beautiful, steady, upward climb. It's the kind of thing that makes a value investor's heart sing. This isn't some crazy volatile stock. This is a business that is reliably getting more valuable year after year after year. So what is this book value thing anyway? Think of it this way. It's the company's rock-bottom tangible worth. If you sold off every desk, every computer, paid every bill, it's what would be left over for the owners. It's a super conservative measure of a company's value. And this right here is the whole ballgame, the aha moment. Back in 2011, the stock was selling for around $21 a share, but its book value, its liquidation value, was $28 a share. The market was giving you the chance to buy $1 for 75 cents. It was an incredible bargain for a world-class business. And here's another way to look at how good of a deal it was. The company was making $2.40 for every share out there. If you only had to pay $21 for that share, your return on the business's earnings right out of the gate was over 11%. For a stable giant like this, that's fantastic. Okay, so an 11+% return to start is great. But Buffett's not in it for a quick flip, right? He's a 10-year guy. So the next logical step is to ask, okay, what could this thing look like a decade from now?
And we can actually make a pretty solid guess. It's not rocket science or a crystal ball. It's just a simple 4-step process using the company's own history and some pretty conservative assumptions to map out a logical future.
So stick with me. Here's how it works. You take the current earnings, that $2.40, and you let it grow at its historical rate for 10 years. That gets you to future earnings of about $3.18 per share. Then you have to guess what people will pay for those earnings. We'll use a price-to-earnings ratio of 12, which is the lowest it had been in a decade, so super conservative. You multiply that PE of 12 by the future earnings, and you get a potential future stock price of around 38 bonds. So what does that all add up to? Well, when you figure out the return from buying at 21 and maybe selling at 38 10 years later, and you add in the dividends they pay you every year along the way, you get a projected annual return of about 7.5%. Now, that might not sound like a get-rich-quick number, but for a low-risk, world-class business, that is a solid, predictable, sleep-well-at-night kind of return.
And this whole analysis really brings us to the final and I think the most important takeaway. This isn't just a history lesson about a stock, it's about a timeless way of thinking. And so we land on this simple but really powerful question. For Warren Buffett, a predictable, low-risk 7.5% annual return on a fantastic business that he could buy for less than it was worth, well, that was interesting enough to put down $51 million. So after seeing how it all breaks down, the question isn't just about a stock, it's about a mindset. And the real question is, what do you think? Today, we're going to talk about a company you definitely know, Coca-Cola. But we're not just going to look at it as that red can you see everywhere. We're going to look at it as a legendary investment, a true case study in how fortunes are built. So let's get into it. I want to start with just one number, 1.6 billion. What is that? Well, that's how many servings of a Coca-Cola product are sold every single day. That number is just staggering, and it perfectly captures the scale of what we're talking about here. This isn't just a brand, it's a part of daily life for the entire planet. So here's our game plan. We'll start with the crazy origin story, from a pharmacy cure to a global icon. Then we'll break down the brilliant business model that made it all possible. After that, we'll shift gears and look at it through an investor's eyes, specifically Warren Buffett's. And we'll wrap up by running some numbers ourselves to see what the future might look like. All right, so let's start at the beginning. Our story doesn't begin in some sleek, modern headquarters. Nope, it starts in Atlanta, right after the Civil War, with a pharmacist who was in a pretty tough spot. This pharmacist, John Pemberton, was a veteran, and like many at the time, he got hooked on morphine to deal with his pain. He was desperately trying to find a way out, so he started experimenting. He came up with this coca wine drink, and eventually, he tweaked it into a non-alcoholic syrup that he called Coca-Cola. It was first sold as a health tonic, for 5 cents a glass at the local pharmacy. And you know what? It was not an overnight success. Far from it. In the entire first year, they only sold 25 gallons. And then, in a move that seems absolutely wild today, Pemberton and his partners ended up selling the rights to the formula for just $2,300. The guy who bought it, an entrepreneur named Asa Candler, had no idea he was sitting on a gold mine. Okay, so this is where the story really starts to get interesting. Asa Candler wasn't just some guy who got lucky. He was a business genius, and he came up with a system that would fuel insane growth for decades to come. Candler's plan was actually pretty simple, but it was revolutionary. He decided the Coca-Cola company would do one thing and one thing only: sell the syrup. He completely avoided the expensive, difficult business of bottling and shipping. Instead, he licensed out the rights to local entrepreneurs who would do all the heavy lifting. This franchise model meant Coke could pop up everywhere super fast without the main companies spending a fortune on factories. It was brilliant. And yeah, it worked. Big time. By 1918, you had almost 1,000 different bottling plants all over the country. The whole system was a massive success. So successful, in fact, that a year later, Candler sold the company to a group led by Ernest Woodruff for $25 million. A pretty nice return on that initial $2,000 investment, huh? So if Asa Candler conquered America, Ernest Woodruff was the guy who set his sights on the rest of the world. He was in charge for the next 60 years, and his mission was to make Coca-Cola a global name. And Woodruff was relentless. He got Coke into the Olympics in 1928.
Then, during World War II, he made an absolutely genius move. He promised that any American soldier could get a Coke for 5 cents, no matter where they were in the world. To pull that off, he built 64 bottling plants overseas. This not only supported the troops, it basically gave Coke a free infrastructure for global expansion after the war. From there, the company started diversifying, buying Minute Maid and launching the smash hit that was Diet Coke. You see, the company realized its distribution network was its superpower. It wasn't just about the classic Coke anymore. Over the years, they rolled out or bought up a whole portfolio of drinks, turning their system into a superhighway for all kinds of beverages. Eventually, they were selling over 100 different brands all over the world. So we have this incredible story of a business taking over the world. Now, let's switch hats. Let's look at Coca-Cola not as a drink, but as an investment, through the eyes of the master himself, Warren Buffett. And this is really the key question for any investor, right? The story is great, the brand is everywhere, but what does that actually mean in terms of dollars and cents? How do you figure out what something like that is worth, especially after it's already been successful for 100 years? Well, this is what Warren Buffett's company, Berkshire Hathaway, paid for their stake. A little under $1.3 billion between 1988 and 1994. Now, that was a huge bet on a company that a lot of people thought was already past its prime. And by 2011, that same investment was worth $13 billion. That's a tenfold return, and it doesn't even count the billions they collected in dividends along the way. It's just a perfect example of what can happen when you buy a fantastic business and just sit on it. So let's do it. Let's pop the hood and deconstruct the numbers to see what Buffett saw. What makes a company like this such a predictable, wealth-generating machine? First, let's look at something called earnings per share, or EPS. You can just think of it as the company's profit for each share of stock. And between 2001 and 2011, Coke grew those earnings at a really solid, predictable clip of over 9% a year. That consistent growth is basically the engine that drives the stock price up over the long haul. Now let's look at the book value per share. This is basically what the company would be worth if you sold off all its assets. This number grew even faster at more than 12% a year. This is what long-term investors just love to see. It means the real underlying value of the business itself is growing like clockwork, year in and year out. Okay, so to connect those two things, we can use a metric called rate of return on book value. All this really tells you is how good a company is at making money with the money it already has. It's a great way to measure how efficient and profitable the business really is. And for Coca-Cola, this number is just phenomenal. You take their earnings of $3.85 and divide it by their book value of $14.60, and you get a return of over 26%. That means for every dollar of capital in the business, they were generating 26 cents in profit. That is an incredibly efficient money-making machine. So now for the fun part. Using this historical data, let's try and do a little back-of-the-napkin math to project what an investment might look like over the next 10 years. Okay, let's walk through this. First, we take those 2011 earnings and just assume they keep growing at that same 9% a year pace for a decade. That gets us to future earnings of about $9.27 per share. Second, we multiply that by a fairly conservative price multiple of 16, which gives us a projected stock price of around $148. And finally, you can't forget the dividends. We add those in, and we get a total value of over $167 a share. So what does that all boil down to? Well, based on this projection, starting from 2011, an investor could have expected a potential annual return of almost 10%. Not bad for a big, boring company, right? And this final thought really puts it all into perspective. You might hear 9.9% a year and think, that's all right. But for Warren Buffett, that level of predictable, steady return was so exciting that he was willing to bet $13 billion on it. It just goes to show, sometimes the most powerful investment ideas are the simple ones hiding right there in plain sight.
Welcome to The Explainer. Today, we are diving deep into a multi-billion-dollar investment that, at first glance, seems to make zero sense. We're talking about a move by one of the world's most famous investors that looked like it broke all his own rules. So, here's the central puzzle we're going to solve today. Warren Buffett, a guy who famously avoided the crazy up-and-down world of oil and gas, all of a sudden plows more than $2 billion into ConocoPhillips. Why? I mean, this move just flew in the face of everything the market expected. So today, we're going to figure out his logic.
And to make things even crazier, this was not some instant home run. In fact, his company, Berkshire Hathaway, was initially down $78 million on this bet. So not only did Buffett break one of his golden rules, it kind of looked like he was getting burned for it right out of the gate. You have to wonder, what in the world was he seeing?
All right, so what did he know that nobody else did? Here's our roadmap. We're going to break it all down and literally follow the breadcrumbs of his thought process.
Okay, first things first. Let's just wrap our heads around the incredible scale of this investment. Just how big of a swing was this, really?
The numbers here really tell the story, don't they? We're talking over 29 million shares, costing Berkshire more than $2 billion. And by 2011, this massive position was already in the red. Now, for most of us, that's a signal to freak out, right? But for a value investor like Buffett, seeing a great company's stock price dip isn't a mistake. It's an opportunity.
You know, to really get what Buffett saw in ConocoPhillips, you got to look past the spreadsheets. You have to dig into its DNA. Because this isn't just the story of one company, it's actually the story of two classic American pioneers that came together to form a giant.
Man, this timeline is just incredible. You've got two companies that were born from completely different philosophies. One was all about logistics and solving a real-world problem for regular people. The other, it was pure adventure, pure risk-taking. And for over a century, they grew on these parallel paths until, bam, they finally merged in 2002 to create this absolute titan of the energy world.
So the Conoco side of the story? It's like something straight out of a business school case study. It all started with one simple, brilliant idea. The founder, Isaac Blake, saw a town using dim, super expensive candles and whale oil for light. He thought, wait a minute, I can use this brand new railroad to ship in kerosene and make it so cheap everyone can afford it. Just brilliant.
But then you have the Phillips story, and it is a totally different vibe. This was pure grit and just an unbelievable streak of luck. You've got two brothers, Frank and Ellie Phillips, who go hunting for oil, and they don't just find a little. No, they hit 81 straight gushers. 81. That's how you build an empire from scratch.
All right, so now that we know where this company came from, let's get to the absolute heart of the matter. Why did Buffett, a guy who famously hated this type of business, make such a massive exception? This right here is the core of his whole argument.
Yeah, this quote says it all. This was Buffett's view of oil companies for decades. He saw them as a terrible long-term investment because they were basically just melting ice cubes. You pump out the oil, you sell it, and all you've got left is an empty hole. So for him to drop $2 billion on ConocoPhillips, something had to have totally flipped that idea on its head.
And boom, here it is. This slide is the whole shebang, the big aha moment. This is the massive disconnect that caught his eye. In 2011, you could buy a share of this company on the stock market for about $67. But if you just added up the value of all the proven oil it had in the ground, that was worth nearly $588 per share. Think about that. It's like being able to buy a $10 bill for $1. The market was completely ignoring the value of the actual stuff the company owned.
And this enormous gap between the price and the actual value is what investors like Buffett call the margin of safety. The best way to think about it is like a giant financial cushion or a safety net. It meant that even if he was wrong about a few things or if oil prices dipped, he was buying the assets so incredibly cheap that his risk of losing big was super, super low.
But here's the thing, right? A pile of cheap assets isn't worth much if you don't have a good business that can actually turn those assets into cold, hard cash. So the next piece of the puzzle for Buffett was to look past the oil in the ground and check under the hood. Was this company actually a strong, profitable machine?
And when you look at the company's earnings per share over that decade, you see exactly what he was hoping to find. I mean, sure, it was a bumpy ride. You can see that big dip in 2009 when oil prices crashed. But the overall trend, it's undeniable. It's a powerful march upwards. The company's profits grew by a whopping 187% in 10 years. And if you smooth out all those bumps, that comes out to an average growth rate of over 11% a year compounded. Now, for a massive company in a notoriously tough industry like oil, that kind of steady performance is a huge, flashing green light for a long-term investor.
So next, we can look at its book value per share, which is, just a fancy way of saying what the company is actually worth on paper. And guess what? It tells the exact same story. You can just see it steadily climbing, proving that the business itself was just getting more and more valuable year after year.
In fact, check this out. Its book value grew at almost the exact same rate as its earnings. Now, when you see those two numbers growing together like that, it's a very powerful signal. It tells you that the company is taking its profits and smartly reinvesting them back into the business, making the whole enterprise stronger and more valuable over time.
Okay, so let's recap. We've got ridiculously cheap assets. We've got a proven history of strong growth. Now we get to the really fun part, using that history to kind of peek into the future and see what this investment could be worth. And look, you don't need a PhD in finance to do this. We can just run a simple, pretty conservative calculation. You start with the earnings from 2011, that's $8.35. Then you just assume it keeps growing at that same historical rate of about 11% a year. You project that out for 10 years, and you land at a potential earnings power of over $24 a share.
So what's a company earning $24 a share actually worth? Well, if we put a very conservative price tag on it, a price-to-earnings ratio of just 7, which is low for this company, that gets you to a future stock price of about $168. That alone is more than double what you paid. And that's not even counting the cash dividends you'd be collecting for 10 years. You add those in, and the total potential value is almost $195 a share.
So let's put all these pieces together. We've got massively undervalued assets, a proven engine of financial growth, and a simple projection showing some huge potential upside. It's time to bring it all home for the final verdict.
What this all boils down to is a potential annual return of 11.25% every year for a decade. I mean, that is an incredibly attractive, market-beating return, especially when you consider it's for a relatively safe, multi-billion-dollar bet on an established industry leader.
And this brings us right back to where we started. When you see the chance to make a double-digit return year after year in a proven business, and your entire investment is protected by a giant safety net because you're buying assets for pennies on the dollar, well, that $2 billion question kinda answers itself, doesn't it? It stops looking like a crazy gamble and starts looking like plain and simple logic.
You know Costco. Of course you do. The giant carts, the amazing $1.50 hot dogs, the endless maze of free samples. But what if I told you that behind all the bulk-sized everything, there's a brilliant business paradox, one that turned a simple warehouse into a global retail empire? Well, in this explainer, we're going to decode exactly how they pulled it off and why one of the world's greatest investors couldn't help but take notice. Just picture this for a second. You're walking down an aisle, you pass a giant pallet of Kirkland socks, and right next to it, a case of premium French champagne. Yep, the fancy stuff. The kind of brand you'd expect to see locked in a glass case at a high-end store. But here it is, just sitting there, at a warehouse price. And this isn't some weird one-time thing. No, this is their entire philosophy. It's the whole game. Selling high-end, brand-name goods for way, way less than you'd expect. It's a paradox that, on the surface, feels like it just shouldn't work. But as we're about to see, it's the very engine that powered Costco into one of the biggest retailers on the entire planet. All right, so here's how we're going to break it all down. First, we'll dig a little deeper into that core paradox. Then, we're going to zoom out and look at the sheer scale of this global retail machine. After that, we'll put on our investor hats and ask the big Warren Buffett question. Is this actually a good business to own? From there, we'll decode the growth engine, project a decade into the future, and finally, see why it justified a massive, massive bet. So let's start with that paradox. At its heart, what Costco really does is tap into a very specific desire, especially for the upper middle class. It's this idea that you can live a richer lifestyle, have the nice things, but do it smartly at a discount. It's all about getting the good stuff without feeling like you're paying that premium price. And the sheer variety is what makes it work. It's not just about the paper towels. It's the fact that you can find premium Titleist golf balls, the latest electronics, and even book an entire vacation package, all in the same trip where you buy your milk and eggs. The whole thing is like a carefully curated treasure hunt, constantly reinforcing one single message. Here, you can have it all for less. And clearly, this model didn't just resonate with people, it was a home run. But the real story is just how big this thing got. This business didn't just grow, it absolutely exploded from a single warehouse into a genuine global force. By 2011, Costco was pulling in a staggering $85 billion in annual sales. Just let that number sink in. That's not just a successful company. That is a global economic machine. And it was all built on that one simple paradox of selling luxury for less. And the growth was incredibly fast. I mean, it was founded in 1983 in Seattle, and it took less than 30 years to hit that $85 billion mark. And you can see a really key moment there in 2002. That's when Berkshire Hathaway, one of the most famous investment firms in the world, gave its stamp of approval and bought in. And that $85 billion wasn't just coming from the US, not by a long shot. By 2011, the company had expanded aggressively all over the globe. We're talking Canada, Mexico, the UK, all the way to Japan and Australia. It turned out the Costco model had some serious international appeal. Okay, so this brings us to a really crucial pivot in our story. We've seen why shoppers absolutely love Costco. I get it. But what about investors? You know, people like Warren Buffett? Does selling everything at a steep discount actually make the people who own the company any money? This is the fundamental question, right? It's the only one that really matters if you stop looking at Costco as a place to shop and start looking at it as a business to own. Are those low prices actually good for the business, or are they only good for the customers? The answer to that question, well, you're not going to find it in the aisles next to the rotisserie chickens. You find it in the financial statements. So let's get into it. Let's decode the growth engine by looking at the cold, hard numbers. Now, before we dive into the data, just a quick definition so we're all on the same page. We're going to talk about earnings per share, or EPS. It's a key metric. Just think of it as how much profit the company makes for each individual share of its stock. If EPS is consistently going up, that means the shareholders are in fact getting richer. And here is our answer. The numbers from 2001 all the way to 2011 show this clear, powerful upward march in profitability. Now, notice that little dip in 2009? That was the global financial crisis. But just look at how fast it bounced back and blew past its old high. That kind of resilience, that is exactly what serious investors are looking for. So when you average it all out, what do you get? Costco grew its earnings per share by almost 10% every single year for a decade straight. That, my friends, is the definition of powerful compounding growth. And to put that number into perspective, to show you just how impressive that is, let's compare it to one of the most legendary investments on Earth, Coca-Cola. In that exact same 10-year period, Costco actually grew its earnings faster than Coke. And this is why investors, including Buffett's famous partner Charlie Munger, got so excited that Munger actually joined Costco's board. And it wasn't just about the profit either. The company's book value per share, which is basically just a measure of its core net worth, shows the exact same beautiful upward trend. The business itself was just becoming fundamentally more valuable year after year after year. Okay, so with a decade of incredible history behind it, the next logical question for an investor sitting there in 2011 was, what happens next? Can we use all this great data to project what a Costco investment might be worth 10 years down the road? Well, here's how you'd build a forecast like that. It's actually pretty straightforward. You start with the earnings you know from 2011. Then you apply that historical growth rate, that 9.85% for 10 years. That gives you a future earnings number. From there, you can estimate a future stock price, add in any dividends you expect, and boom, you get a total projected value. And here's what that projection looks like visually. An investment made at $81 a share back in 2011 was forecast to be worth over $170 a decade later. So based on its history, this was a business that had the potential to more than double your money. So what does all this mean in the real world? It means that this wasn't just a great place to buy a giant tub of pretzels. It was a potentially great investment. And this projected return is exactly why an investor like Warren Buffett, through his company Berkshire Hathaway, was paying very close attention. When you actually run the math, that projected growth from $81 to over $170, it works out to a compounding annual rate of return of 7.71%. And that number, that's the bottom line. That's the result of the whole investment thesis. And that return, you know, it's not some flashy get-rich-quick number, but it was steady, it was predictable, and it was backed by a decade of rock-solid performance. And it was interesting enough to justify Berkshire Hathaway's position, which was worth $351 million back in 2011. So there you have it. We've gone from the champagne in the shopping cart all the way to the compounding returns in an investment portfolio. We've seen the powerful, consistent logic that led one of the world's greatest investors to bet hundreds of millions on this retail empire. The data suggested a potential annual return of over 7%. And the only question left to ask is the one every investor has to answer for themselves. Is that interesting to you?
All right, today we're going to crack open a classic Warren Buffett investment, the pharmaceutical giant GlaxoSmithKline. You probably know it as GSK. We're going to get right into the nuts and bolts of why Berkshire Hathaway took a huge stake in this company. And maybe more importantly, what the logic behind that whole bet can teach us about playing the long game in investing.
So it all kicks off with this puzzle. I mean, just imagine this for a second. You are the most celebrated, most successful investor on the planet. You make your move, you buy into a company, and boom, almost immediately, you're in the red. It just doesn't add up, right? But, with an investor like Buffett, there is always more to the story than just the daily stock price.
And look, we're not talking about a small paper loss here. This is over $15 million. For pretty much anyone else, seeing that much red on your screen would be a giant flashing sign to panic and probably sell. For Buffett, though, it was just noise. So the real question is, what on earth did he see that the rest of the market was missing?
To solve this little puzzle, we have to do exactly what Buffett does. We have to ignore the little squiggles on the stock chart that go up and down every day and really look at the actual business underneath it all. The answer isn't in the price. It's in the company's long-term economic power. And that all comes down to one really, really key concept.
This right here, this is the holy grail for value investors. A durable competitive advantage. Buffett famously calls it an economic moat. And it's exactly what it sounds like, a big, protective barrier that keeps all the competitors away and lets a company just rake in high profits for years and years and years. Well, it turns out GSK has two incredibly powerful ones.
So let's start with the first one, which is, you could argue, the most impressive of all, GSK's vaccine business. You see, this isn't just a good business, it's basically an economic fortress. And the numbers that back this up, they're just staggering. Okay, it all starts right here. The actual cost for GSK to make one single dose of a childhood vaccine is incredibly low. We're talking about $1.50. Just burn that number into your brain, because it is the foundation of this entire profit machine.
Now, look at the price tag. GSK turns around and sells that very same vaccine dose to governments and national health programs for around $9. So you go from $1.50 to $9. That is a massive markup, and it just screams pricing power.
So here's the takeaway. For every single shot that's administered, GSK pockets about $7.50 in pure profit. It's a ridiculously high-margin product. But the real magic, the real wow moment, happens when you think about the sheer scale of this whole operation.
So let's zoom out. Every year, something like 133 million babies are born around the world. Health authorities recommend they get multiple vaccinations, right? So the potential market is just enormous. If you multiply those births by the number of shots, and then by that $7.50 profit, you get a potential worldwide profit pool of nearly $34 billion. Every single year. That's not a stream of cash, that's a river.
So you're probably asking, well, why can't other companies just jump in and get a piece of that? Well, this is the moat in action. First, new vaccines get 20-year patents. That's a legal monopoly right there. Second, GSK has these deep, long-standing relationships with governments. They are the trusted supplier. Third, you need a mind-boggling amount of money to even try to compete at this scale. And finally, in the US, vaccine makers have legal immunity, which just massively reduces their business risk. It really is a fortress.
Okay, so now let's look at the second major advantage for GSK, the incredible power of its brand name drugs. This one is less about the economics of manufacturing and way more about marketing and just human psychology.
This right here is the key insight. You see, even after patents expire and cheaper generic versions pop up, a lot of people stay loyal to the brand they know and the brand they trust. I mean, it makes sense, right? When it's your health on the line, familiarity and what you perceive as quality often beats price. Doctors and patients get into a habit, and that habit is incredibly profitable.
And for a perfect example of this, you just have to look at Advair. Through all that direct-to-consumer advertising, GSK basically embedded this brand name into the minds of millions of people. Patients would literally go to their doctor and ask for Advair by name. And what was the result? A recurring stream of income that hit $8 billion in sales in a single year. That's the power of a brand.
Okay, so we've got a great story, right? A vaccine goldmine, powerful drug brands. It sounds fantastic, but do the financial results actually back up this narrative? You know, Buffett always looks for a track record of strong, consistent performance. So let's see what the data has to say.
So here are the earnings per share for GSK over a 10-year span. And what you're seeing is a really clear upward trend. Yeah, there's that dip in 2010, but that was just because of some one-time restructuring charges. The really important part is how fast the earnings bounced right back the very next year. That shows you the underlying strength of the business.
And when you visualize it like this, as a bar chart, the growth becomes even clearer. I mean, it just pops. From $1.44 per share in 2001 all the way up to $3.80 in 2011. That's a 163% jump over a decade. This is the kind of consistent, powerful growth that really gets a value investor's attention.
And if we boil all of that data down to just one single powerful number, this is it. GSK grew its earnings at a compounding rate of over 10% a year for 10 straight years. That is just a beautiful, predictable, and highly attractive growth engine. Okay, so we have all the pieces of the puzzle. We've got a fantastic business, it's got these powerful moats, and it's got a proven track record of growth. So now, let's put it all together and see this investment through Buffett's eyes, to really understand why he pulled the trigger.
To do that, we need to understand this really neat idea called the equity bond concept. Try to think of buying a stock not as a piece of paper that wiggles around, but think of it like you're buying a bond. The price you pay for the stock, that's your principal. And the company's earnings per share, that's like the annual interest you get on that principal. It's a really simple but powerful way to look at things.
So here's how the calculation works. You start with the earnings from 2011, which were $3.80 a share. Then you just project that forward for 10 years using that historical growth rate we found, that 10.19%. That gives you a projected earnings per share of just over $10 in 2021. And if the stock trades at a similar valuation multiple, well, that implies a future share price of over $110.
And this just lays out the opportunity so clearly. The market, at the time, was offering shares for about $40. But the projection, which was based on a solid decade of performance, suggested a value of over $110 in 10 years' time. I mean, that is a huge potential upside.
But wait, that's not even the whole story. The return doesn't just come from the stock price going up. Oh no! GSK also paid out a pretty hefty dividend. So over those 10 years, those dividend payments would add a really significant chunk to your total return, making the whole thing even more attractive.
And here it is, the bottom line. When you combine the projected stock price going up with that steady stream of dividends coming in, the analysis showed a potential compounding annual return of over 12.6%. And that is the answer to our puzzle. This is what Buffett saw. That short-term $15 million paper loss was completely, totally irrelevant when you're looking at a predictable, double-digit annual return over the long haul. Which brings us right to our final thought here. The whole GSK story, it kind of forces us to ask a really fundamental question about investing, doesn't it? When is a short-term loss actually a long-term win? Well, the answer, as Buffett showed us, is when you've bought a wonderful business at a fair price and you just have the patience to let its true value unfold over time.
You know what really separates a decent company from a truly great long-term investment? It's a question every single one of us asks. Well, today, we're going to try and find some answers by doing a deep dive on a name we all know, Johnson & Johnson. And we're going to look at it through the exact lens of one of the world's most successful investors.
So let's just start with one number, and it's a big one. $2.93 billion. Back in 2011, that's roughly what Berkshire Hathaway's stake in Johnson & Johnson was worth. And look, that wasn't just another line item on a balance sheet. It was a huge vote of confidence from one of the most respected investment minds on the entire planet.
A number that big just immediately makes you ask the question, right? And that's really the core of what we're digging into today. What in the world did Buffett and his team see? What were the fundamental strengths that made Johnson & Johnson worth a nearly $3 billion bet?
To figure that out, we're going to follow this simple roadmap. We'll start with the bet itself, then we'll dive into the company's, well, its fortress of brands. We'll uncover a kind of hidden tax advantage, look at a solid decade of growth, project what the future might have looked like from that point, and then finally, we'll reach the investor's verdict.
Okay, let's get into it. Pillar number 1, that fortress of enduring brands. This is the stuff you can see and touch, the most obvious reason for the company's incredible staying power. These are the products we all know and have probably been using our entire lives.
I mean, really think about this list. This isn't just a collection of products. It's practically a guided tour of your family's medicine cabinet. You've got Band-Aids, Tylenol, Listerine. These aren't just brands. They're basically institutions. They've carved out this permanent, trusted space in our minds, which creates this deep psychological moat that is just incredibly difficult for any competitor to get across.
And that brand power creates a massive economic advantage. Just compare J&J to, say, an automaker. A car company has to pour hundreds of millions, sometimes billions, into research and development, and then completely retool their factories every few years just to launch a new model. J&J's factories, on the other hand, they just keep churning out the same trusted products for decades. Yeah, they replace parts when they wear out, but they get to completely sidestep the massive, constant cost of reinventing themselves. The cash just keeps flowing in.
All right, now for pillar number 2, the international tax advantage. So beyond the stuff we see on the shelf, there's something much less visible but incredibly powerful at play here, what our source material calls a hidden engine for growth. This is a classic example of one of those durable, really hard-to-copy competitive advantages that long-term investors are always hunting for.
So what we're talking about is this concept called undistributed international earnings. To put it simply, any profit J&J makes overseas doesn't get hit with U.S. taxes until they decide to bring that money back home. So what does a smart company do? Well, it reinvests those profits abroad, letting them grow and grow, pushing that tax bill off, maybe forever.
And just how much money are we talking about here? It's pretty staggering. By the beginning of 2011, Johnson & Johnson had piled up a $37 billion war chest overseas. Think about that. That's a massive pool of capital that is constantly working for the company, constantly growing, all while being deferred from taxes.
And just to put that into perspective, this chart shows that back in 2011, almost half, 48% of the company's entire pile of retained earnings was sitting in that overseas treasure chest. You know, far away from the U.S. taxman and just free to grow without any friction. And here's where you see the real power of that strategy. Let's just run a little projection. If that $37 billion grows at, say, 10% a year for a decade, it balloons to roughly $100 billion. But if it had been taxed along the way, it would have only grown to about $65 billion. That is a $35 billion difference created for shareholders purely because of this tax advantage. It's incredible.
The source material we're analyzing really just sums it up perfectly. This isn't your normal, everyday compounding. Because that money is growing on a pre-tax base, it's like compounding on steroids. And for any long-term investor, that kind of supercharged growth is just unbelievably attractive.
Okay, moving on to pillar number 3, a decade of consistent growth. So we've got the awesome brands and the killer tax advantage, but did all that actually translate into real results? Well, the proof, as they say, is in the pudding, or in this case, the numbers. And J&J's track record is just remarkably consistent.
Just take a look at this relentless upward march of its earnings per share, or EPS. That's just the company's profit divided by its shares. From 2001 to 2011, it just climbed and climbed, from $1.91 to $4.95. That's a super steady compound annual growth rate of almost 10% for a whole decade without a single down year. And you know what? We see the exact same story with book value per share, which is basically the company's net worth on a per-share basis. This metric actually grew even faster at over 11% a year during that same time. This is just hard proof that the company's underlying intrinsic value was just steadily and predictably climbing, year after year after year. Okay, so this brings us to our 4th pillar, projecting a future return. When you have a history of growth this consistent, you can actually try to project what an investment made back in 2011 might look like a decade later. So let's put on our analyst hats for a minute and run the numbers together. We're going to use a simple 4-step process here. First, we'll project the future earnings per share. Second, we'll use that to guess at a future stock price. Third, we'll add in all the dividends we'd expect to collect. And finally, we'll crunch it all down to a total annual return. All right, step 1, projecting the earnings. We start with that 2011 EPS of $4.95, and we let it grow at that historical rate of 9.99% for 10 years. The math spits out a projected EPS for the year 2021 of $12.83. Now for step 2, let's estimate the stock price.
If we apply a really conservative price-to-earnings multiple of 12, which was a historic low for J&J, to our projected earnings, we get a future stock price of $153.96.
Okay, now for the final steps. We have to add in all the dividends an investor would have collected over that entire decade, and then we calculate the total annualized return. So the bottom line from all this analysis, it's a projected compound annual return of 10.52%.
And that brings us right to our final section, the investor's verdict. We've looked at the brands, we've looked at the tax advantage, we've looked at the growth. Now let's tie it all together and finally answer that multi-billion-dollar question we started with.
The verdict from this whole analysis is actually pretty clear. The bet was justified by 4 key things. You had a fortress of durable cash cow brands, a really powerful tax advantage that was like a growth accelerant, a proven decade-long track record of just rock-solid results, and finally, a pretty reasonable projection for a solid annual return of over 10%. You see, for a long-term, value-focused investor, that combination of safety, predictability, and a solid return is an incredibly powerful draw. It was definitely enough to justify that multi-billion-dollar position from Berkshire Hathaway. So we'll end this with the exact same question that the source material posed. Does a projected 10.52% annual return backed by that kind of stability, does that perk up your ears?
Welcome to The Explainer. Today, we're digging into a huge bet made by a legendary investor on one of America's most iconic food companies. It's a story all about cheese, cookies, and, you guessed it, brilliant business strategy.
So let's just start with a number that kind of sets the whole scene. $3.2 billion. I mean, that's not just a lot of money. For one of the most careful investors in the world, that's a massive statement.
And that massive investment from Warren Buffett's Berkshire Hathaway into Kraft Foods, well, it really makes you ask the question. Think about it. This was in the early 2010s. The market was still a bit wobbly, tech was all the rage. So why would Buffett go all in on a company that makes stuff you find in pretty much any kitchen pantry?
By 2011, you can see Berkshire had built up this huge position, over 97 million shares, that gave them 5.6% of the entire company. So you see, they weren't just dipping their toes in the water, this was a major strategic move on a real food giant.
To really get the why behind this billion-dollar bet, you have to rewind the clock. You have to go all the way back. The story of Kraft is really a masterclass in building the one thing Buffett absolutely loves, a company with a deep, protective economic moat.
I mean, it all started with one guy, James L. Kraft, literally selling cheese door to door in Chicago. But, the real game changer was innovation, getting a patent for pasteurized cheese. This meant it lasted way longer, which led to a massive contract with the U.S. Army in World War I, getting millions of soldiers hooked. And later, they were pioneers in TV ads, proving they knew how to build a brand for the modern age.
But they didn't stop there. No way. The company grew into this global powerhouse through a very deliberate, very aggressive strategy of just gobbling up other companies. It was time to build an empire.
And the strategy behind it all was actually incredibly simple, but so powerful. It wasn't about chasing the latest fad. It was about owning the products that are just staples in our kitchens, things we buy over and over again, generation after generation. And boy, did that strategy pay off. Just look at this lineup. We're talking absolute icons here. Oscar Mayer, the king of lunch meat. Oreo, probably the world's favorite cookie. Cadbury, a global chocolate giant. I mean, these aren't just products, they're practically part of our culture. And every single one is a market leader.
And this quote just perfectly captures the whole idea, right? 100 years from now, you can bet kids will probably still be twisting open Oreo cookies. These are products that don't need expensive, constant upgrades to stay relevant. Their value is in their consistency.
So you had all these huge corporate moves over the decades that were all about bringing these amazing brands under one giant roof. From merging with National Dairy way back in the 30s to the massive acquisitions by Philip Morris and then later buying Cadbury, every step was about consolidating power and creating this unmatched food giant.
Okay, so the story's great. The brands are legendary. But for an investor like Warren Buffett, a good story just isn't enough. You gotta see the numbers. The numbers have to work. So let's pull back the curtain and look at the engine that was driving this whole empire.
First up, let's talk about something called earnings per share, or EPS. All this really is a way to see how much profit the company is making for every single share of its stock. It's a really basic but really important measure of how profitable a company is.
And check this out.
Over that 10-year period, from 2001 to 2011, Kraft's earnings per share pretty much doubled. That's a huge green flag. It tells you the business itself was getting more and more profitable, consistently.
But here's the really incredible part. That growth averaged over 6.5% every single year. And think about the timing here. That period includes the 2008 financial crisis, right? A time when tons of companies were just falling apart. Kraft, it just kept growing.
Okay, so we see the profits were growing, but what about the company's actual tangible value? What's it fundamentally worth? For that, we look at something called book value per share. You can think of it as what the company would be worth per share if it sold off everything it owned.
And would you look at that? It's the exact same story. Just like the earnings, the company's book value showed that same strong, steady, predictable growth over the decade. The company wasn't just earning more, it was becoming fundamentally worth more.
This is the kind of chart that long-term investors just dream about. It's not flashy, it's not some crazy tech stock, it's just this slow, steady, almost boringly beautiful increase in real value, year after year after year.
So what's the bottom line here? It's really simple. People have to eat. When the economy got rough, people didn't stop buying mac and cheese. They didn't stop buying Oreos. The fact that people need these products created this fortress of strong, steady profits.
Okay, so you've seen the history, you've seen the stability. Now let's put on our investor hat for a second. If it were 2011, how would you even begin to figure out what this investment might be worth 10 years down the road? Let's walk through the math.
All right, so you start with what you know, right? You take the earnings from 2011, which was $2.20. You use that historical growth rate of 6.5%, and you just project it forward for 10 years. What do you get? A potential earnings per share of over $4. And this is where the magic really happens. Think about it. If you paid $35 for that share back in 2011, and then 10 years later it's earning over $4, your return on that original $35 is now almost 13.5% a year. That is the power of compounding earnings.
And believe it or not, that's not even the whole story, because we haven't even talked about dividends yet. Just the stock price going up would give you an annual return of about 4.2%. But Kraft was also paying out cash to its shareholders. When you add those dividends back in, suddenly your total projected annual return jumps up to over 6.3%.
So this all comes down to one big question. And it's a question for any investor, really. Is a steady, predictable return of over 6% a year, projected out for a whole decade, a good enough deal for you to put your money on the line?
Well, for maybe the greatest investor of all time, the answer was a big fat yes. That combination of brands that last forever and cash flow you could count on, that was the perfect recipe for a multi-billion-dollar bet. And of course, that bet would keep evolving with the company's split and its massive merger with Heinz later on, proving that even with stuff in your pantry, the story is never really over.
Okay, let's talk about a real head-scratcher. You look at this company's books, and on the surface, it looks like a total nightmare. But then you see that legends like Warren Buffett think it's an absolute dream. We're talking about Moody's Corporation, and we are going to solve this puzzle. How did a business that's technically worth less than zero become one of the most profitable companies on the planet? All right, so here's our game plan. First, we're going to lay out the puzzle itself. Then we'll dive right into the ratings game, what this company actually does. After that, we'll pull back the curtain on its asset-light profit machine, see how it uses its cash to fuel insane growth, and even try to forecast its future value. And stick around, because at the end, we'll get to the big takeaway for any investor out there.
All right, let's jump right into the big mystery here. Because when you look at a company like Moody's, there's this massive disconnect, right? Between what the accounting books tell you and what some of the sharpest financial minds in the world are seeing. So here it is, the heart of the puzzle. You look at the balance sheet, and Moody's has a negative net worth. I mean, its liabilities are bigger than its assets. Now, for pretty much any other company on Earth, that is a blaring 5-alarm fire red flag. It's supposed to be a sign of major financial trouble. So, what in the world is going on? And yet, look at this. Back in 2011, this number represented the value of Berkshire Hathaway's stake in Moody's. We're talking about Warren Buffett's company. They turned an initial investment of about $284 million into over $900 million. That's just a crazy amount of profit from a company that, if you just looked at the books, seems like it should be totally broke.
Okay, so the answer clearly isn't hiding in the standard accounting reports. To crack this case, we gotta put on our detective hats. We have to look past the balance sheet and really dig into what Moody's does, and more importantly, why its business model is so incredibly special. So to get why they're such a powerhouse today, we've got to go back in time a bit and really unpack the history here and the whole credit ratings industry. So this whole thing started way back, over a century ago. John Moody began by analyzing railroad bonds. Super niche, right? But he built this reputation for solid analysis. They expanded, and by 1924, believe it or not, they were the authority, covering pretty much the entire U.S. bond market. But here's the kicker, the real game changer. In the 1970s, they flipped their business model. Instead of just charging investors for the reports, they started charging the companies and governments that were issuing the bonds. And boom, that created this massive, super reliable river of cash. And all that history has led to just incredible dominance in their market. I mean, look at this. Today, the credit rating world is basically a duopoly. That means you've got two big players who own almost everything. Moody's has a whopping 40% of the market, and their main competitor, S&P, has the other 40%. When you have that little competition, that's a huge advantage. Now, it's also worth knowing that Moody's Corporation is kind of like two companies in one. You've got Moody's Analytics. They sell financial software, research, that kind of thing. But the real heart of the operation, the absolute engine of this whole thing, is Moody's Investor Service. That's the ratings agency we've been talking about, the one that tells the world how risky corporate and government debt is. Okay, so we've got this dominant business model, but how does that actually turn into jaw-dropping profits? Well, this is where the clues start coming together and we really begin to solve our puzzle. I mean, just how profitable are we talking? Let's look at their operating margin. That's the profit they make on every single dollar of sales. Moody's consistently pockets about 50 cents of every dollar that comes in. Now, to put that into perspective, you take legendary companies like Coca-Cola or Johnson Johnson, they're down in the low 30s. Moody's is just playing a completely different game. So how on earth is that possible? Well, the secret sauce is that Moody's is what we call an asset-light business. Think about it. They don't need giant factories or expensive machinery or a huge network of warehouses. Their most important asset isn't something you can physically touch. It's intangible. It's their brand, their reputation, and their essential role in the entire global financial system. And this brings us right back to that head-scratcher from the beginning. Remember that negative net worth? Back in 2011, their physical stuff, their assets, were worth about $2.5 billion, but they owed $2.7 billion in liabilities. That's where the negative $200 million comes from. And the paradox just vanishes when you realize their most valuable asset of all, that rock-solid reputation that just prints money year after year, doesn't show up on the balance sheet at all. It's invisible to accountants, but not to smart investors. So, you've got this business that's a cash-generating machine, right? It's raking in hundreds of millions in profit, but it doesn't need to pour that money back into building new factories or buying equipment. So what does it do with all that cash? Well, a huge part of the answer is this number right here. Between 2001 and 2011, Moody's went out and bought back 76 million of its own shares from the market. They spent over $4.4 billion doing it. Now, why would they do that? Simple. By taking those shares out of circulation, they make every single share that's left just a little bit more valuable. And the result of that buyback strategy is exactly what you see here. A really powerful and consistent climb in what's called earnings per share, or EPS. By buying back all that stock, the company's earnings for each share jumped from just 66 cents all the way up to $2.45 by 2011. Think about that. Over a decade, they grew their earnings per share at a compounding rate of over 14% every single year. This is the holy grail for long-term investors. It's a powerful, predictable growth engine. It's exactly what people like Buffett are always on the hunt for. Okay, now this is where things get really cool. We can actually take all this historical info and use it to build a pretty logical forecast for the future. We can actually run the numbers to see what an investment in Moody's might look like 10 years down the road. All right, let's walk through this step by step. Back in 2011, you could buy a share for about $32, and it was earning $2.45. That's a pretty nice starting return of 7.6%. Now let's just assume that it keeps growing at that historical 14% rate we found. Fast forward 10 years to 2021, and the company would be earning about $9.10 per share. If the market gives it a pretty conservative PE ratio of 12, that would mean a stock price of around $109. And don't forget the dividends. You add those in, and the total value per share gets to over $114. You run the math on that whole journey, and it comes out to a compounding annual return of almost 14%. Pretty amazing. So after digging through all of this, what's the big takeaway? What's the one really important lesson here? Well, it all boils down to a super important concept that investors call an economic moat. And the ultimate proof of this idea isn't just in a spreadsheet. It's in the conviction. When someone like Warren Buffett puts nearly $1 billion of his company's money behind an idea, well, that tells you everything you need to know. So when you put it all together, you've got this dominant market position, an asset-light model spitting out cash, insane profit margins, and that consistent growth. All of it combines to build a virtual fortress around the business. That is what we mean by a deep, durable economic moat. It's a competitive advantage that's just almost impossible for anyone else to get across. And that really brings us to the final thought here. The story of Moody's is a fantastic lesson in learning to look beyond the obvious, beyond just the balance sheet. So the question I'll leave you with is this. Now that you know what to look for, what other amazing businesses are out there, hiding their own powerful economic moats right in plain sight?
It's kind of funny when you think about it. There are these giant companies hiding in plain sight all over our homes, and we barely even notice them. Today, we're going to pull back the curtain on one of the biggest of them all, Procter & Gamble. Now, you might not know the P&G name, but I promise you, you know their brands. All right, so here's our game plan for unpacking this consumer goods behemoth. First, we'll explore the P&G empire that's probably in your bathroom cabinet right now. Then we'll jump in a time machine to see how they got so huge. After that, we'll dig into their secret sauce for success, get our hands dirty with the financials, and for fun, we'll even try to see what the future might look like.
Okay, first up, let's just take a second to realize how deeply Procter & Gamble is woven into our daily lives. I mean, their entire business model is built on being, well, everywhere. And look at this list. I mean, this is just scratching the surface. We're talking about absolute titans of industry. Tide, Gillette, Pampers, Duracell. Come on. These aren't just products. They're household names that basically own their categories.
Seriously, think about your morning. Did you brush your teeth with Crest, do a load of laundry with Tide, shave with a Gillette razor? See, this right here is the heart of P&G's power. They make the stuff that billions of us use up, and then have to buy again, day in and day out.
So how in the world did one company build this unbelievable roster of brands? Well, it definitely didn't happen overnight. Their dominance is really the story of nearly 200 years of smart, consistent, and sometimes game-changing innovation.
This timeline just lays it all out. It starts with a simple partnership between a candle maker and a soap maker way back in 1837. A huge early break for them was supplying the Union Army during the Civil War. From there, it was just one hit after another. Ivory, the soap that floats, which was a huge deal back then, Tide, which completely changed how we do laundry, and Pampers. I mean, talk about changing parenting forever. And then, bam, 2005, they pull off this massive acquisition of Gillette, basically creating a super company and becoming the biggest player on the planet.
And get this is one of my favorite little business tidbits ever. P&G didn't just invent new products, they basically invented modern marketing. They created an entire entertainment genre, the soap opera, for the literal purpose of selling more soap. That's some next-level thinking, and it shows you how they build brands that last for generations.
So what makes this empire so unbreakable? It's protected by what smart investors call a moat. Think of it like a castle. It's a set of powerful advantages that are just incredibly tough for any competitor to get past.
So, what's P&G's secret sauce? Well, it seems to be a powerful mix of 4 key things. First, their products are consumable. You have to keep buying them. Simple, but brilliant. Second, brand loyalty. We're talking about generations of trust. Third, their global scale is just immense. 31 factories in China alone, just to give you an idea. And fourth, they have a really smart tax strategy that lets them use their international profits to grow even faster.
And the results of that moat? They're just staggering. I mean, 70% of the entire global market for razors. That's just wild. And having 40% of the North American laundry detergent market with just one brand, Tide, is a testament to its power. Some of these brands are so big they could be Fortune 500 companies all by themselves.
And this number, $30 billion. What does that even mean? Well, this was the pile of profits P&G had sitting overseas back in 2011. And by keeping that money abroad, they could pour it right back into the business to fuel more growth, all without taking an immediate tax hit in the US. That is a massive financial advantage.
Okay, now let's pop the hood and see what the engine looks like. How does this powerful business moat actually translate into financial results? Well, the numbers from 2001 to 2011 tell a really compelling story.
So in just 10 years, P&G more than doubled its profits for every single share of its stock. That's solid, but check this out. The growth in its book value per share, that's like the company's fundamental net worth, it grew by a mind-blowing 455%. Now that's how you build some serious long-term value.
And just look at the earnings year by year. You can literally trace the line going up with your finger. It's just this incredibly steady, predictable climb. No bad years. Just consistent growth. It's like a financial heartbeat, a profit machine that grew its earnings by almost 10% a year, every year, for a whole decade.
And the growth in that core net worth is even crazier. You can actually see the moment the Gillette acquisition happened. Look at that massive jump between 2004 and 2006. That wasn't just adding brands, it was fundamentally changing the company's value. All told, the company's net worth per share compounded at over 18% a year. That rate of growth is just incredible.
So this leads to a really cool way to think about a business like this, sometimes called the equity bond concept. The idea is, instead of obsessing over a wiggly stock price, you view the company itself as an asset that's generating a return. And in 2011, P&G's business engine was cranking out an 18% return on its own net worth. That's a powerful machine.
All right, this is where the fun begins. Can we actually use P&G's steady past to peek into its future? Let's run a little experiment and see if we can project what a 10-year bet on the company might have looked like. So here's some back-of-the-napkin math. We start with their 2011 earnings per share, which was $3.98. Then we say, okay, what if their earnings just keep growing at that same historical rate of about 9.8% a year? We project that out for 10 years, and we get a future earnings per share of $10.16. Finally, we can multiply that by the historic PE ratio, which is just a fancy way of saying how much people have historically paid for their earnings, to get a potential future stock price. And what do we get? A projected stock price of over $166. Now, considering the stock was trading around $61 back in 2011, that's a pretty fantastic return from the growth of the stock alone.
But wait, there's more. A company like P&G doesn't just grow its value on paper. It actually pays its owners, the shareholders, cash money. We can't forget about the dividends.
Right. So when you add in all those sweet dividend checks that would have been paid out over that decade, the total projected return on that 2011 investment jumps to a whopping 207%. That's more than tripling your money on what might be one of the most predictable companies on the planet. So is this just a fun little thought experiment, or is there some real-world proof that this is a sound way to think about things? Well, it just so happens that one of the greatest investors of all time was a huge fan.
That's right. As of 2011, Warren Buffett's company, Berkshire Hathaway, had a stake in P&G worth about $4.4 billion. I mean, when an investor of that caliber makes a bet that big, it's about the most powerful vote of confidence you can get in a business's long-term strength.
And that's what it all comes down to, really. It leaves us with this fascinating question. In a world that's obsessed with the next shiny new tech gadget, could it be that the smartest, most reliable way to build wealth is hiding in plain sight, in the simple, boring, everyday stuff that we all can't live without? Something to think about.
All right, welcome to The Explainer. Today we're going to do something a little different. We are going to jump in a time machine and head back to 2011 to pick apart a massive, multi-billion-dollar investment. Why? Because we want to get inside the head of a value investor and see exactly how they analyze a company.
Everything kicks off with this number right here, $2.06 billion. Back in 2011, this is how much money Warren Buffett's company, Berkshire Hathaway, had sunk into one single pharmaceutical business.
And that really is the big question, isn't it? Why Sanofi? To figure that out, we have to put on our analyst hats. We're going to break down the company, its business, and the numbers, just like an investor would have had to do way back then.
Okay, so here's our game plan. First, we'll look at the investment itself just to set the stage. Then we'll really get to know Sanofi as a business. After that, it's all about the numbers. We'll decode their growth, run something called an equity bond analysis, try to project a future value, and then wrap it all up by calculating the potential return.
All right, first up, let's get the hard facts on Berkshire Hathaway's stake in Sanofi according to their 2011 filings.
Now, this is where it gets really interesting. Look at that last line. After putting in over $2 billion, Berkshire was actually down $250 million on paper. This tells you everything about the value investing mindset. You don't care about what the stock price is doing today or tomorrow. You care about the real long-term value of the business itself.
So let's dig into that business. What was it about Sanofi that made it seem like such a good long-term bet, even with that temporary dip?
Well, for starters, Sanofi wasn't some small up-and-comer. We're talking about an absolute heavyweight. By 2011, it was the third largest pharma company on the entire planet by prescription sales. And it got that big by making smart, huge acquisitions that expanded its power and its reach.
And here's a huge piece of the puzzle, a key part of Sanofi's competitive advantage. It was a subsidiary called Sanofi Pasteur. You see, the vaccine business is an absolute powerhouse. You have demand that basically never stops growing. And the profits? Just incredible. And Sanofi Pasteur was the biggest company in the world that did nothing but vaccines.
And if you want to talk about scale, get a load of this. 1.6 billion. That's how many vaccine doses they pumped out in 2010 alone. That's enough to protect over 500 million people. That is a massive, durable, and very profitable operation.
Okay, so we know the business model is solid. Now let's look at the proof. What does the financial history tell us? The numbers never lie.
So just take a look at their earnings per share from 2004 all the way to 2011. You can see a couple little wiggles here and there, which is totally normal. But the overall picture? It's a clear, strong, powerful march upwards. The company was getting more and more profitable.
And this chart just makes it pop.
I mean, look at that. From $1.27 a share to $2.90. The earnings more than doubled in just this 7-year window. That's some serious, consistent growth.
So what does all that growth boil down to? It comes out to this number, 12.5%, compounded every single year. For a value investor, a number like this is absolute gold. It's not just a report card on the past, it's maybe our best clue for what might happen in the future.
Okay, so we've got this fantastic historical growth rate, but how do you use that to figure out if the stock is a good buy today? That brings us to our next move, the equity bond analysis. It's a way to calculate our starting return.
You know, this is such a powerful way to think about stocks. It helps you cut through all the day-to-day market noise. You just pretend you're not buying a volatile stock. Instead, you're buying a bond. And the company's earnings, that's your yield, your interest payment. It forces you to focus on the business fundamentals.
And the math behind it? It's actually really simple. You just take the earnings per share for 2011 at $2.90, and you divide it by what one share cost at the time, which was around $35.
And that gives us our starting yield, an initial return of 8.2%. Now that's pretty good, but here is the magic trick. Unlike a regular bond, or that payment is fixed forever, the yield on this equity bond is expected to grow every single year.
And now, for the fun part. Let's pull out the crystal ball. Using everything we've learned, we're going to try to project what Sanofi's earnings and its stock price might look like a full decade into the future.
The logic here is pretty straightforward. We start with our 2011 earnings of $2.90, then we take that historical growth rate we found, 12.52%, and we just let it compound for 10 years. If things continue, that gives us a potential earnings per share in 2021 of $9.43.
So if the company is earning almost $9.50 a share, what could the stock itself be worth? Well, we can estimate by applying a price-to-earnings ratio. And to be safe, this analysis uses a pretty conservative number, a PE of 11. You multiply that by our projected earnings, and you land on a potential stock price of over $100 a share.
Okay, we are in the home stretch. Let's pull all the pieces together. We have to look at the potential stock price going up, plus the dividends an investor would get along the way to see what the total projected return might be.
And when you add the projected stock appreciation to a decade's worth of dividend payments, you get this, a potential total return of 247%.
Now, a 247% return over 10 years sounds amazing, but what does that actually mean on a year-by-year basis? Well, it breaks down to this. It's a compounding annual rate of return of almost 13.3%. That's the engine, working for you year after year.
So look, this isn't financial advice, of course. It's a framework for how to think. It's a rational, patient, business-focused way to evaluate an investment. And in the end, it leaves us with the same question every value investor has to answer for themselves. Is that potential return worth the risk involved? That's a question only you can answer.
All right, let's dive right in. Today, we're going to put on our value investor hats and break down a company the way a financial legend might. And our case study for this is Torchmark Corporation. Now, I know what you're thinking. An insurance company? Sounds kind of boring, right? Well, as we're about to find out, sometimes the most incredible investments are hiding in the most unlikely, even boring places. So here's the game plan. First, we'll look at why a heavyweight investor even gave this company a second look. Then we'll jump into its history, uncover its secret weapon for making money, and then we'll analyze the numbers like a pro. After that, we'll try to project out the future and, finally, get to the bottom line. What's the return? Okay, so let's kick things off with a question that gets this whole thing started. Why on earth would a firm like Berkshire Hathaway, one of the most successful investment operations in the world, be interested in what looks like a plain vanilla insurance company? And that really is the heart of the matter, isn't it? While a lot of people are chasing the next flashy, high-flying tech stock, truly brilliant investors are often looking for something completely different. They're hunting for solid, predictable, profit-gushing businesses that everyone else is just ignoring. So let's pop the hood on Torchmark and see what they saw. And look, this isn't just some academic exercise. The proof is in the pudding. By 2011, Berkshire had already taken a nearly $58 million bet and turned it into over $100 million. That's a clean profit of almost $44 million. When you see numbers like that, it's not just a good return. It's a signal that something really powerful is going on with this business. So, how does a company like this get so strong? Well, you gotta look at its roots. These kinds of financial powerhouses aren't built overnight. This one's foundation was laid down over 100 years ago. You can see right here, this is a story of slow, steady, methodical growth. It started out as a small fraternal group way back in 1900 and just patiently expanded, decade after decade, by making smart, strategic acquisitions. This wasn't about wild gambles, it was about building brick by brick. Okay, now we get to what I think is the secret sauce. This is the real magic behind the curtain. Beyond just selling insurance, Torchmark had this incredible financial engine humming under the hood, and its main purpose was to create massive value for its shareholders. Just look at these two numbers side by side. On the left, you see the company's total profits. They grew by 38% over about a decade. You know, that's pretty good, respectable. But then you look at the right. The earnings for every single share exploded by 188%. So what gives? How did the earnings for each share grow almost 5 times faster than the company's total profits? Well, the answer is just brilliant in its simplicity. Think of the company's total profit as a big pizza. If the pizza stays about the same size, but you keep reducing the number of people who get a slice, what happens? Well, the slices for everyone who's left get a whole lot bigger. That's exactly what Torchmark was doing. They were buying their own shares, their own slices of the pie, making every remaining slice that much more valuable. And this number just shows you the incredible scale of what they were doing. They weren't just nibbling around the edges here. Over 11 years, Torchmark bought back and basically vaporized 44%. We're talking nearly half of its own company. This super aggressive buyback strategy is the reason that per-share earnings number went through the roof. It is a masterclass in smart capital allocation. Now, to really wrap our heads around this, we need to use a mental model that the pros use all the time. It's called the equity bond concept. It sounds a little fancy, but it's actually a super simple and powerful way to think about what you're really buying when you purchase a stock. The whole idea is to stop looking at a stock as a little ticker symbol bouncing around on a screen. Instead, think of it like a bond. A bond pays you interest, right? A yield? Well, we can figure out a similar yield for a stock. You just take what the company earns per share and divide it by what you paid for that share. That number tells you, for every dollar you invest, how much profit the business is kicking back to you each year. It's that simple. So let's apply this. First, we need the raw data. Here are Torchmark's earnings per share over that decade. And what you see isn't a crazy roller coaster ride. It's a steady, predictable, beautiful upward climb. It goes from just over $2 a share to almost $5. This is the kind of reliable profit engine that value investors absolutely fall in love with. And the story's just as good when we look at book value per share. You can basically think of this as the company's net worth, what would be left over for shareholders if they sold everything and paid off all their debts. And just like the earnings, this fundamental measure of the company's value has also been growing like a weed. It shows the business isn't just making money, it's getting fundamentally more valuable year in and year out. So let's just boil all that history down into two simple numbers. Over that decade, earnings per share grew at an average clip of about 8.4% a year, and book value grew even faster at almost 11% a year. Now, of course, what happened in the past isn't a guarantee for the future, but these numbers give us a really solid, reasonable starting point for our projections. All right, here comes the fun part. Let's take everything we've learned, all that historical performance, and try to look into the future. Let's project what a potential investment made back then could look like over the next 10 years. So step one, we figure out future earnings. We start with the known earnings from 2011, which was $4.65 a share. Then we just let our historical growth rate of 8.43% do its thing, compounding year after year for a decade. And if you run that math, you land at a projected earnings per share of about $10.45 by the year 2021. Okay, so if the company is earning $10.50 a share, what might the stock be worth? Well, to figure that out, we need to apply what's called a price to earnings, or PE ratio. It's just a measure of how many dollars investors are willing to pay for $1 of the company's earnings. We're going to be conservative here and use a PE of 8. We multiply that by our projected earnings, which gets us a future stock price of about $83.60. But wait, there's more. You also would have collected dividends for 10 years. Add those in and you get a total projected value of $88.50 for each share you own.
So we've looked at the history, we've dissected the strategy, we've run the projections. It's time to bring it all home. What's the bottom line? What's the one number that tells us that this whole deep dive was worth it?
And there it is, 9.41%. Based on our analysis, if you had bought the stock for $36 in 2011 and a decade later it was worth a total of $88.50, your investment would have compounded at an annual rate of 9.41%. That is the potential reward you get for your patience.
And that brings us right back to the beginning. This whole analysis, all the history, the buybacks, the math, it all boils down to this one simple personal question. Is a potential annual return of 9.5% good enough for you? Is it tantalizing enough to make you invest? Now, there's no right or wrong answer here. It all depends on your own financial goals. But for some of the smartest investors on the planet, it was more than enough. The only question left is, what would you do?
Today, we're digging into a true giant of American industry, Union Pacific, but we're going to do it from a really interesting angle. We're looking at it through the eyes of one of the world's most famous investors and trying to figure out why he walked away from what could have been a billion-dollar home run. Let's get right into it. Take a good look at that number, over $1 billion. That's what Berkshire Hathaway's stake in Union Pacific could have been worth. A huge bet by one of the sharpest investors on the planet. So, what happened? And that really is the million, or I guess billion-dollar question, isn't it? Why would you sell a winning hand like that? Well, the answer comes down to one little word: antitrust. See, back in 2009, Berkshire sold off its shares because they were about to buy Union Pacific's main competitor, Burlington Northern Santa Fe. Owning both? No way. That would have set off all sorts of regulatory alarms. To really get why these railroad giants are so valuable and so carefully watched, we've got to go back in time. To really appreciate just how powerful the railroads are today, you have to understand their absolutely wild history. Seriously, it's a story of monopolies being built, torn down, and then built all over again in a totally new way. I mean, just look at this journey. It's a total roller coaster. In the early 1800s, if you wanted to ship something far, railroads were your only real choice, a total monopoly. By 1900, the big industrial barons had rolled this power into massive trusts. Of course, that made a lot of people angry, leading President Teddy Roosevelt to famously bust them up. But then, fast forward to the mid-1900s, and the industry is on the verge of collapse, getting hammered by trucks and airplanes. And that's when, in this crazy twist, the government steps back in and paves the way for a whole new era of railroad power.
And what's just incredible here is the sheer concentration of power. We're talking about names like Harriman, Hill, JP Morgan, Rockefeller. These guys were titans, and they figured out that if you control the rails, you control the economy. Their game plan was simple and, well, brutally effective. Buy up the railroads, kill the competition, and then you can charge whatever you want and make an absolutely insane amount of money.
And this is the real irony of the whole story. The very same government that had spent decades tearing apart the railroad monopolies was now forced to put them back together. With the 1958 Transportation Act, they basically hit the brakes on antitrust laws for the rails. Why? Well, the country realized it just couldn't function without them for hauling heavy stuff. This move let them merge and get big again, not to squeeze the public, but to actually survive against the new kids on the block, trucks and airlines.
So here's the key takeaway. This new era, where the government was okay with consolidation, allowed the railroads to build an incredibly strong competitive advantage. In the investing world, people call this a moat. It's like a protective barrier around your business that keeps competitors out.
And this modern moat is built on two giant pillars. First up, regional monopolies. All those mergers meant that in a lot of places, there was only one railroad in town, no more direct competition. And second, an advantage that became a superpower: fuel efficiency. When diesel fuel shot up from like 25 cents in the 70s to over $4, what was a nice little advantage suddenly became a massive economic weapon.
Let's actually put some numbers on that. A Union Pacific train can haul 1 ton of stuff for an unbelievable 865 miles.
On a single gallon of diesel. Just let that sink in for a second. The scale of that efficiency is just mind-boggling. And right here, this comparison just lays it all out. A train is almost 5 times more fuel efficient than a truck. So when you combine that huge permanent cost advantage with the fact that they're regional monopolies, well, you've got yourself the recipe for a very, very profitable business.
Okay, so that's the story. That's the theory. But does that powerful moat actually show up in the real world, on the bottom line? Let's switch gears and look at the numbers and see what they tell us.
All right, this is the first question you'd ask about any business, right? Are they actually making money? And maybe more importantly, for every dollar that comes in, how much do they get to keep?
This chart tells such a clear story. Back in 2001, Union Pacific's net profit margin was about 8%, pretty decent. But by 2011, it had more than doubled to over 17%. That tells you the fundamental business was getting stronger and more profitable year after year.
And to really understand how good 17% is, look at this. A big trucking company like Werner runs on margins around 5%. Union Pacific just crushes that. What's really wild is that its profitability is actually in the same ballpark as a global brand powerhouse like Coca-Cola. That is what a deep, powerful economic moat looks like in the real world.
Okay, so they're super profitable. Check. But is the business itself, the actual tangible stuff, is that growing over time? That's the next big question we have to ask.
And once again, the numbers paint a really clear picture. Book value per share, which is kind of a rough sketch of a company's net worth, went from just over $19 in 2001 to almost $41 in 2011. That's a steady, consistent climb, showing the business is getting more and more valuable every single year. Profit is good, growing value is great, but for anyone looking at this as an investment, it really boils down to this, doesn't it? How are the earnings per share looking? Over that decade, Union Pacific grew its earnings per share by an average of 13.15% every single year. That's not just strong, it's remarkably steady. It shows that the company's economic engine isn't just humming along, it's actually picking up speed. Okay, so we've got all this great historical info. How would an investor use that to try and peek into the future? Now, look, this is definitely not investment advice. Think of it more as a fun exercise to see how you could use this data to guess what the company might be worth down the road. So let's walk through a super simple projection. First, you take what you know. The 2011 earnings were $6.50 a share. Then you just grow that number by that historical 13.15% for 10 years. That gets you to a potential earnings of over $22. Third, you slap a historical price to earnings multiple on that to get a potential stock price. And last, you can't forget to add in all the dividends you'd probably collect along the way. So what does that all add up to? Well, if you started with a stock price of $100 in 2011, this simple projection suggests a potential sale price of over $300 10 years later.
Throw in the dividends, and you're looking at a total projected return of 226%. That works out to a potential return of about 12.5% a year.
And that really brings us right to the final question, the one every investor has to answer for themselves. We've seen the incredible history, the powerful economic moat, the rock-solid financials. And based on that, a simple projection points to a potential annual return of 12.5%. So the big question is, for a business this solid, this dominant, is that an attractive return for you? Welcome to The Explainer. All right, today we're going to dig into a classic Warren Buffett investment, one that really shows you how he thinks. We're looking at U.S. Bancorp. We're going to explore what the world's most famous investor saw in this bank, especially at a time when the market was basically screaming at him that he'd made a $500 million mistake. Okay, let's just kick things off with a number that would probably make most of us, completely panic. In 2011, this was the unrealized on-paper loss that Berkshire Hathaway was sitting on with its investment in U.S. Bancorp, a staggering $500 million in the red. And that, right there, is the big question we're tackling today. Why on earth would Warren Buffett not only hold this stock, but believe in it? You see, for Buffett, a falling stock price isn't a reason to panic. It can be an opportunity to buy more of a great business at a discount. So let's figure out why he was so convinced this was a great business to begin with. All right, so here's how we're going to break it all down. First, we're going to look at the sheer size of this bet. Then we'll get into what makes this bank so unique. After that, we'll dive into the numbers, we'll run a little 10-year projection, and we'll finish up with the ultimate question that every investor has to face. Okay, first things first, we really need to wrap our heads around just how big of a commitment this was. This wasn't some small speculative play for Berkshire Hathaway. No, this was a major, high-conviction investment. So look at this. This table tells such a powerful story. Berkshire had poured a massive $2.4 billion into this company, paying an average of over $30 a share. But by 2011, the market value had tanked, creating that huge paper loss. For most people, that's a giant red flag, right? A signal to get out. But for Buffett, well, that's just a test of his homework. So what gave him that conviction? How could he sleep at night with that kind of paper loss? To understand that, we have to look past the blinking stock ticker and get into the company's DNA. What exactly makes U.S. Bancorp tick? This number right here, this is a huge piece of the puzzle. Since 1988 alone, U.S. Bancorp had successfully bought or merged with over 50 other banks. So you see, this wasn't just a bank. No, this was a master acquirer, a company that was exceptionally good at growing by intelligently buying up its competitors. And if you need any more proof of just how much trust Buffett had here, check this out. This isn't just about financial calculations for him. The fact that he physically keeps his own Berkshire stock certificates, worth tens of billions of dollars, in a U.S. Bancorp safety deposit box, well, that speaks volumes about his faith in the actual integrity of the institution.
Okay, so we've got this great story, right? A well-run, stable company that's a master acquirer. But for an investor like Buffett, a good story is nothing without the numbers to back it up. The data has to support the narrative. So let's decode the financials.
And we're going to start with a big one, earnings per share, or EPS. All this really tells you is the company actually making money for its owners? It's a fundamental indicator of profitability. Is it working?
And when you look back at the history, from 2001 to 2011, the answer is a resounding yes. You can really see the earnings power here. Sure, it took a hit in 2009. I mean, who didn't during the global financial crisis? But the key is, it didn't lose money, and it bounced back fast. That's resilience. So if you smooth all that out, the good years and that one tough one, what do you get? You get a steady, compounding annual growth rate of 4.5%. That's the kind of consistent, predictable growth that value investors just love to see. All right, next up is another metric that's right up a value investor's alley, book value per share. Think of it as the company's net worth on a per-share basis. The question here is the core business itself getting more valuable over time? And wow, when you look at this chart, the story gets even better. Just look at this trend. From 2001 straight through 2011, there wasn't a single year where its book value per share went down. Not one, not even in the middle of the worst financial crisis in generations. This is just a picture of a relentless value-creating machine.
And that unwavering performance translates into an impressive 6.9% compound annual growth rate in its book value over that decade. This is that strong underlying economic engine that Buffett saw, way beneath the day-to-day fluctuations of the stock price. Okay, so we've done our homework, we've seen the evidence. A resilient earnings machine with a steadily growing book value. Now let's put on our investor hats and use this data to project a potential return, just like Buffett might have done. Let's run a little test.
The question is pretty straightforward. Let's put ourselves back in 2011. The stock's trading at $24 a share, everyone's scared. What kind of return could we reasonably expect to get over the next 10 years if we bought in right then? We can work this out using a pretty simple 3-step analysis. First, we'll project the earnings forward. Then, we'll estimate a future stock price based on those earnings. And finally, we'll calculate our total return, making sure to include dividends.
All right, step 1. We start with the 2011 earnings per share of about $2.05. If we grow that forward for 10 years using that historical 4.5% annual rate we found, we land at a potential EPS of about $3.18 by the year 2021.
Okay, so what might the market pay for those earnings in a decade? Now, to be super conservative, let's not use an average price to earnings ratio. Let's use the stock's 10-year low PE ratio, which was 12.3. You multiply our projected earnings of $3.18 by that conservative PE, and you get a potential future stock price of about $39. Now we can see what that means for our return. If you buy at $24 and you sell 10 years later at a projected $39, that alone would give you an annual compounding return of 5%. Now that's not bad, but hold on, we're not done yet. Right? You can't forget about dividends. That's the cash the company pays you just for owning the stock, and it's a direct return on your investment. To get the total picture of our potential return, we have to add that in. And once you factor in those projected dividend payments over the 10-year period, our total potential annual return jumps up to 6.28%. This is the number an investor in 2011 could have reasonably projected using nothing but the company's own history and a pretty conservative valuation.
And that brings us to the final question, the one every investor has to answer for themselves. Based on the evidence, is a projected return of 6.28% per year from a stable, industry-leading bank interesting to you? Well, Warren Buffett evidently found it interesting enough to invest $2.4 billion. And that right there shows you the difference between reacting to a scary market price and analyzing the durable business underneath.
Welcome back to The Explainer. Today, we're hopping in the time machine and setting the dial for 2011. We're going to look at a company that was, well, by pretty much any measure, the biggest in the world, Walmart. But we're not just looking at it as a place to shop. We're going to break it down as an investor, through the eyes of a value investor, to see if this absolute retail giant was actually a smart buy.
So, here's our game plan. First, we're going to try to wrap our heads around just how massive Walmart was. Then, we'll peel back the layers and find the secret to its dominance. After that, we'll dive into a decade of its financial performance, analyze it like a pro, and yeah, we'll even try to predict its future. And it's all leading up to that one big question. Was it a good investment?
All right, first up, let's talk about scale. Because to really understand Walmart back in 2011, you have to appreciate its sheer size. And I'm not kidding, the numbers are so big they're almost hard to believe.
Let's just start with its workforce. Walmart had over 2 million employees. That's not just a company. That's bigger than the population of a lot of major cities. It was, by a long shot, the largest private employer on the entire planet.
And, okay, what about the money it was bringing in? The revenue? In 2011, Walmart's sales topped $421 billion. That single fire hose of cash made it the largest company in the world by that measure. Period.
And this scale was built on a global empire of over 8,400 stores. And what's interesting is, while everyone knows the name Walmart, they were actually operating under 55 different brands in 15 countries. Things like Walmex in Mexico, Asda in the UK, and Seiyu in Japan. Sam Walton had truly built a global retail machine.
So how in the world did they get this big? It wasn't just about having low prices. The secret was a powerful, self-reinforcing business model. It's pretty simple in theory, but in practice, it was incredibly effective.
This right here is the Walmart flywheel. It all starts with them buying products in absolutely massive volumes. That gives them the power to go to suppliers and demand lower prices.
Then they pass those savings on to us, the customers, which drives even more sales. This cycle just keeps repeating, gaining more and more momentum with every single turn, and eventually smaller competitors, well, they just can't keep up.
And what this flywheel did was create this deep, protective moat around the business. A new competitor couldn't just show up and compete on price because they just didn't have the purchasing power to get the same deals. Walmart had effectively locked up the market.
You know, a great business model is one thing, but the real proof is always in the numbers. And Walmart's financial performance from 2001 to 2011 really shows the power of that flywheel in action. It was converting that market dominance into predictable, growing profits.
First, let's take a look at earnings per share, or EPS. That's just the profit the company makes for each individual share of its stock. For an investor, this is a huge deal. And just look at it. It's a steady, relentless climb from $1.50 in 2001 all the way to nearly $4.50 by 2011. That's a total increase of almost 200%, averaging nearly 11.5% growth every single year, like clockwork.
And we see this exact same consistent growth in its book value per share. Just think of this as the net worth of the company on a per-share basis if you were to sell everything off. It grew at an average annual rate of over 11%. These numbers show a company that wasn't just big, but it was also a remarkably stable and predictable profit machine.
Okay, so Walmart was a dominant, profitable company. We've established that. But did that make it a good investment? To answer that, we need to shift our thinking. We have to stop thinking like a consumer and start thinking like an owner, just like the legendary investor Warren Buffett would.
So here's a key concept for value investors, the equity bond return. I want you to imagine you owned the entire company, like it was a private bond. The question is, what return is the business itself generating on its own capital? For Walmart in 2011, you just take its earnings per share and divide it by its book value per share. The result? A fantastic 22% return. That tells us the business was incredibly efficient at making money with the assets it already had.
But here's the catch. As an investor, you don't get to buy the company at its book value of about $19. You have to pay the market price, which was around $54 in 2011. So your initial rate of return is the earnings divided by the price you pay, which comes out to 8.2%. Now, that's a solid number, but it's a critical distinction from the company's powerful internal return.
So, what does that 8.2% initial return really mean for the future? Well, we know the company has a history of growing its earnings by over 11% a year. This is where the magic of value investing comes in, projecting what that could be worth down the road. So let's run the numbers and forecast a potential 10-year return.
The first question we need to answer is this. If Walmart just keeps on its historical growth path, what will its earnings power be a full decade into the future, say in the year 2021?
We can use a standard future value calculation to figure this out. We start with the 2011 earnings of $4.45 per share, and we apply that historical growth rate of 11.49% over 10 years. The math suggests that by 2021, Walmart could be earning about $13.20 per share.
That's a pretty strong future earnings number, right? But what does it really mean for an investor? The next logical question is, how do those future earnings translate into a potential stock price?
Well, to estimate a future stock price, we multiply our projected earnings by a price-to-earnings or PE ratio. This ratio just tells us how much investors are willing to pay for each dollar of a company's earnings. To be conservative, we'll use a PE ratio of 13, which was on the low end for Walmart in 2011. $13.20 in earnings multiplied by 13 gives us a projected share price of about $171.60 in 2021. And now for the final calculation, the big finish. We take our projected sale price of $171.60 and we add in the dividends. Walmart was a consistent dividend payer, so we'll estimate about $14.80 over that decade. Then we compare that total to our initial purchase price of $54. The result is a potential total return of 238%, which works out to a compounding annual return of 13.19%.
So, after all that analysis, all that math, it all comes down to that one number, a 13.19% projected annual return. And that leads to a critical decision that every single investor has to make for themselves.
And this really is the ultimate question for you as an investor. For a stable, dominant company like Walmart, is a projected annual return of just over 13% for 10 years a good deal? Is that enough to get you excited, especially considering the relative safety of the investment?
With that question in mind, let me leave you with one final piece of context. For Warren Buffett, arguably the greatest value investor of all time, that potential return, well, it was more than interesting. It was interesting enough for him to invest over 2.1 times billion dollars in the company. A pretty compelling answer to a very important question.
Welcome to The Explainer. Today, we're diving into a real financial paradox. How on earth did the Washington Post company manage to make less money, but at the same time tell its investors that their personal slice of the pie actually got bigger? It sounds impossible, right? Well, the answer reveals one of the most powerful and, let's be honest, sometimes controversial tools in all of corporate finance. So here's our game plan. First, we're going to look under the hood of the Washington Post company to see what it was really all about, beyond just the famous newspaper. Then we'll get right into that puzzling earnings report. After we uncover the so-called magic behind those numbers, we'll see how the legendary investor Warren Buffett used this to his advantage. And then we're going to finish by putting you in the investor seat and asking, would you have made the same call? All right, first things first. Let's get a really clear picture of what this company looks like back in 2011. Because while everyone knew the name The Washington Post, that iconic paper was really just the tip of the iceberg. The business itself was, frankly, a sprawling media empire. I mean, look at this. This was a true media conglomerate. We're talking about the famous newspaper, sure, but also 6 TV stations, a whole network of cable companies, and even Kaplan, that massive test prep company. The big takeaway here is one word: diversification. Having all these different ways to make money was a huge cushion, especially as the internet started to really challenge that traditional newspaper business model. Okay, let's get to the main event, the central mystery of this whole story. It's a real head-scratcher from their financial reports that, at first glance, just seems to defy all logic. So this is where things get really weird. Check it out. In 2011, the company's total profit was almost $40 million less than it was back in 2005. Now, you'd think that the earnings for each share of stock would have gone down too, right? That's just common sense. But look at that bottom line. The earnings per share, or EPS, actually went up. How is that even possible? How can the entire pie get smaller while each individual slice somehow gets bigger? Let's break down the financial engineering that made this seemingly impossible thing happen. And the answer, my friends, lies in a very common but incredibly powerful financial move called a share repurchase, or as most people call it, a buyback. This was the secret ingredient that solved the whole paradox. The concept is actually pretty simple. The company just takes its own cash, goes out into the open stock market, and buys its own stock. Those shares are then basically taken out of circulation, they're retired, which means the total number of shares out there for investors to own goes down. And here's where the math makes it all click. Back in 2005, you take the profit, about $314 million, you divide it by 9.6 million shares, and you get your EPS. Simple. But between 2005 and 2011, the company was constantly buying back its stock, shrinking the total number of shares down to just 7.75 million. So now, if we take that same 2005 profit and divide it by the new, smaller number of shares, poof, the EPS magically jumps to over $40. See? They didn't actually make more money. They just sliced the same pie into fewer but bigger pieces. So, why does this kind of financial wizardry matter so much to an investor? Well, to answer that, let's look at how one of the greatest investors of all time, Warren Buffett, rode this exact strategy to a truly legendary return. Buffett, through his famous company Berkshire Hathaway, started buying up shares in the Washington Post company way back in 1973. He saw the incredible value hiding in all those assets we talked about. Now, fast forward 37 years to 2011, and that same stock was trading for $338 a share. And get this. His total cost to buy that massive stake in the company, just $11 million. By 2011, that little $11 million investment had ballooned into an incredible $583 million. That kind of growth is just staggering. It represents a total return of over 5,000%. And to get a return like that, Buffett's investment had to grow at an average rate of over 11% every single year for almost 4 decades. That right there is the power of finding a fantastic business and just holding on for the long haul. Okay, but that was Buffett, right? He got in during the 70s for $6 a share. The real question is, what if you were the investor looking at this stock in 2011 and the price tag was $338? Was there any value left, or was the big money already gone? Let's try to run the numbers and find out. The very first step in a Buffett-style analysis is to look at the past to try and get a hint about the future. This table shows the company's earnings per share history, and as you can see, it's not exactly a smooth, straight line up. There are definitely some dips in there, probably during recessions, but what we're looking for is the long-term average trend. So if you take all that historical data and crunch the numbers, you find that over this 11-year period, the earnings per share grew at an average rate of about 8.4% per year. This growth rate, well, this is the engine that's going to power our entire projection. Now, with that growth rate in hand, we can build a simple 3-step projection for the next 10 years. Step 1, we'll take that 2011 EPS and grow it by our 8.4% rate for a decade to predict what the EPS might be in 2021. Step 2, we'll estimate a future stock price. We do that by multiplying our future EPS by a PE ratio, which is just a fancy way of guessing how much future investors will be willing to pay for each dollar of earnings. And finally, step 3, we can't forget about the cash. We add in all the dividends we expect to get paid over those 10 years. So here it is, our whole potential investment journey in one chart. We buy one share in 2011 for $338, and based on our analysis, we project that 10 years later, in 2021, the combination of that stock's value and all the dividends we've collected would add up to a total return of over $1,000 per share. Not bad. But, a big dollar amount doesn't really tell the whole story. What we really need to know is the annual rate of return. That's the key number, because it lets us compare this investment to literally any other opportunity out there and decide if it's truly a good deal. And when you run the final bit of math, turning a $338 investment into over $1,000 in 10 years, it comes out to a projected annual rate of return of 12.17%. And what's really fascinating about this number is that it's right in line with the roughly 11% annual return that Warren Buffett himself had earned over the previous 37 years. It seems the opportunity was still there. And that brings us to the core question posed in the analysis we're digging into today. Is a projected return of over 12% a year for potentially 10 straight years good enough to get you excited? It's probably worth remembering that at this very moment, in 2011, Warren Buffett still had hundreds of millions of his own dollars riding on that exact bet. So now the final decision is yours. You've seen the diversified business. You understand the financial mechanics of how share buybacks work. You've seen the legendary returns of the past, and you've walked through a pretty reasonable projection for the future. With all of that information, knowing you've got to pay $338 a share, do you pull the trigger? Would you make the investment? All right, let's dive right in. Today, we are cracking open the playbook on one of Warren Buffett's most legendary investments, Wells Fargo. Seriously, this thing is a masterclass in how to turn a full-blown crisis into a massive win, all built on a foundation of incredible financial discipline. Let's do this. So let's just start with a number that kind of grabs you by the collar, $10 billion. Back in 2011, that was the market value of Berkshire Hathaway's stake in just one company. You gotta understand, this wasn't just another stock pick. Nope, this was a cornerstone of Buffett's entire empire, something he'd been patiently building for decades. So the big question is, how on earth does that happen? How do you build a position that huge, starting right in the middle of a complete banking meltdown? Well, that's what we're here for. We're gonna break down the exact thinking, the surprisingly simple math, and the core philosophy that powered this absolutely incredible bet on one of America's biggest banks. Okay, here's our game plan. We'll kick things off by looking at the sheer scale of this investment. Then we're going to hit the rewind button and go back to the 1990 crisis that opened the door. From there, we'll unpack the key principles of what I'm calling the Buffett doctrine, and we'll even run the numbers on his worst-case scenario stress test. Finally, we'll check out the bank's actual performance and see what the potential payoff really looked like. First up, the scale of the bet. All right, first things first, let's really wrap our heads around the size and the scope of what we're talking about. This was no small-time, casual investment. This was a massive, concentrated position. Let's just pause and let these numbers sink in for a second. By 2011, Berkshire had piled up nearly 360 million shares. That's not just a big number. It meant they owned almost 7% of the entire company. The total price tag for this huge stake was just over $8 billion, and at this point it was worth around $10 billion. So, a cool $2 billion paper profit. But for me, the real kicker is that last bullet point. This was Berkshire's second largest holding, just behind Coca-Cola. I mean, that says it all, doesn't it? It tells you everything about the conviction Buffett had in this one business.
So where does a $10 billion bet like this even start? Well, it wasn't in some quiet boardroom with a bunch of happy charts. No way. It started in the pure chaos of a market meltdown. And this is classic Buffett, right? Finding crystal clear opportunity when all anyone else can see is panic.
So let me set the scene for you. It's the late 80s, and the real estate market is just getting hammered. Banks that have made a fortune on loans were now staring at enormous losses. By 1990, there was blood in the streets, financially speaking. Investors were dumping bank stocks left and right, convinced they were all going to go under. And right then, smack in the middle of all that fear, Buffett strolls in and plunks down nearly $300 million on Wells Fargo.
And this quote from the man himself just nails the mindset. He got it. He saw the chaos. He understood the fear. He says investors understandably concluded that no bank's numbers were to be trusted. He knew why people were selling, but instead of running with the herd, he used their panic as his entry point. He saw fear not as a red flag, but as a sale tag. But here's the thing. This wasn't just about buying something cheap. It was about buying something excellent that just happened to be on sale. And this gets us right to the heart of his entire investment philosophy, what we can really call the Buffett doctrine. The whole decision really boiled down to 3 core pillars. First, he was convinced that Wells Fargo had the absolute best managers in the entire industry, period. Second, he saw a relentless, almost fanatical culture of keeping costs low. And third, it was a business he got, inside and out. It's just banking. He wasn't chasing some complicated newfangled tech trend. This quote right here really hammers home those first 2 points. He gives a shout out to the managers, Carl Reichardt and Paul Hazen, but check out the second part of that sentence. They attack costs just as hard when profits are hitting records as they do when times are tough. That is financial discipline. That's the kind of culture that builds a business for the long haul, and that is exactly what Buffett was betting on.
And this last quote, it perfectly explains that third pillar and his whole mindset. I mean, think about it. If you're going to be a long-term buyer of a business, you should be pumped when the price goes down. It's like your favorite brand of coffee going on sale. But like Buffett says, most investors do the complete opposite. They get giddy when prices are high and miserable when they're low. He just flipped that whole logic on its head.
Okay, so he loved the management, he loved the philosophy, great. But Buffett, he doesn't just go on gut feelings. He has to back it up with numbers. He had to know for sure that the bank could survive a truly awful scenario. He needed a margin of safety. Now, this part is absolutely crucial. Buffett did this beautiful, simple stress test. He imagined a nightmare scenario. What if 10% of all the bank's loans went bad? And of those bad loans, the bank lost 30 cents on every single dollar. So what was the result? Yeah, it was a huge one-time loss. But, and this is the whole point, that loss would only be enough to basically wipe out that year's profits. The bank would break even. It wouldn't make any money, but it would not fail. It would live to fight another day. And that, right there, was the margin of safety he needed to see. And what's so cool is that we can take that exact same thinking and apply it to the much, much bigger bank of 2011. A similar worst-case scenario, then, would mean a staggering $32 billion loss. Wow. But here's the key. By then, the bank was pulling in $15.5 billion in profit every year. So it would take just over 2 years of normal earnings to completely cover that catastrophic loss. The numbers are way bigger, but the principle? It's identical. The bank's earnings engine was just that powerful.
So the theory was solid. The bank was built to last. But did the business actually deliver the goods over the long run? Well, the proof, as they say, is in the pudding. Let's take a look at the actual evidence.
Okay, so this table shows us the earnings per share, or EPS. The easiest way to think about this is it's the company's total profit divided by all its shares. It's basically what your little slice of the business earned each year. And just look at that trend. It starts at less than $1 in 2001, and by 2011, it's almost $3. You can just see that steady march upwards. Sure, there was a dip during the 2008 financial crisis, you'd expect that, but look how fast the earnings roared back to life. That's the growth engine we're talking about. Next up, book value per share.
Now, this is a huge one for Buffett. This is basically the net worth of the company per share. What would be left over if you sold off every asset and paid off every single debt? As an owner, you want to see this number climbing consistently. And as you can see, that is exactly what happened. It went from about $7.77 in 2001 to over $22 by 2011. This is proof that the fundamental underlying value of the business was growing for its owners, year in and year out.
And this chart just puts that growth in perspective. I mean, just look at the difference. The underlying net worth for each share nearly tripled in a single decade. This is what real long-term value creation actually looks like. It's not about the stock price wiggling around day to day. It's about seeing the actual value of the business you own marching steadily higher.
Okay, so we've looked at the history, we've looked at the performance. So for our final section, let's do what every investor has to do. Let's look forward. Based on everything we knew back in 2011, could we have projected a reasonable return? Let's run the numbers.
Stick with me here. This is actually simpler than it sounds. First, you start with what you know, the 2011 earnings per share of $2.85. Step 2, we're just going to grow that number for 10 years using the company's historical growth rate, which was about 11%. That gets us to a projected EPS of $8.20 by the year 2021. The last step is to put a price on those future earnings. We do that with something called a price-to-earnings multiple. All that is a number that tells you how much investors are willing to pay for each dollar of profit. And we'll just use a conservative one, the same one the stock had in 2011.
So what number does that little calculation spit out? A projected share price of over $104. Now remember, the stock was trading for around $28 back in 2011. This simple projection suggested there was a ton of upside if the business just kept doing what it had been doing for years. Then you add in all the dividends you'd have collected along the way, and the projected total return over that 10-year stretch comes out to 289%. That's the incredible power of buying a great business at a fair price and then just letting it do its thing. And so that brings us right to the final question, the one every single investor has to answer for themselves. A potential return of 14.5% a year, projected for a decade, from a business you've already decided is durable and has great management. Is that an attractive investment? Well, for Warren Buffett, the answer was a massive yes, to the tune of $10 billion. And that right there shows you the disciplined, long-term thinking behind one of the greatest investments of all time.
When you hear Berkshire Hathaway, one name probably pops into your head, right? Warren Buffett. And hey, for good reason. For decades, his name has been the gold standard for investing success. But what if I told you that seeing Berkshire as a one-man show, well, it means you're missing the real story, the bigger and, frankly, much more interesting picture.
So let's just ask it. Who really manages the money at Berkshire Hathaway? Who's pulling the levers behind the curtain, shaping one of the most watched investment portfolios on the entire planet? The answer? Well, it might just surprise you, because it's a story that goes way beyond the Oracle of Omaha.
The thing is, Berkshire isn't a monarchy. It's more like a council of brilliant, really distinct investment minds. These are the people working right alongside Buffett, and it's their unique, sometimes even clashing perspectives that create the company's true strength.
All right, so here's what we're going to do. We're going to pull back that curtain and meet the other minds of Berkshire. First up, the legendary Charlie Munger, the visionary partner. Then we'll get to know Todd Combs, the disciplined protege, and Ted Weschler, a guy who is almost a mirror image of a young Buffett. And finally, we'll wrap it all up by asking the big one. What does this team mean for Berkshire's next chapter?
First up, the one and only Charlie Munger. Now, most people kind of see him as Buffett's right-hand man, his advisor. But here's the thing. Sometimes Munger's the one in the driver's seat, pushing Berkshire way, way outside of Warren's comfort zone. And there is no better example of this than his huge bet on a little-known Chinese company called BYD.
Munger saw something just incredible in BYD's story. I mean, look at this. It kicks off in 1995 with a tiny loan, just $300,000. By 2000, they're taking on giants like Sony in batteries. Then, in 2003, they make this totally wild pivot into cars by buying a failing state-owned car company. Can you believe that? And just 5 years later, boom, their F3 sedan is the #1 selling car in all of China. This wasn't just a company, you guys. It was a rocket ship.
And here's the key. This is so important. Munger wasn't just buying into a business. He was betting on a person, the founder, Wang Chuanfu. He saw him as this unbelievable mix, part Thomas Edison, the genius inventor, and part Jack Welch, the master of getting things done. Munger was so sure about this, he put his own money in first, then he went to convince Warren. Now that is conviction.
And you know what? Buffett listened, because Munger's recommendation was just that strong. So in 2008, Berkshire put in $232 million, snapping up almost 10% of the company. I mean, think about it. This was pure Munger, a big, bold, international bet, totally outside of Buffett's usual American-focused playbook.
And here is the result of that vision. Just 3 years later, that $232 million investment, it had exploded to over $816 million. I mean, just a massive, massive return that proved Munger's gut instinct was dead on.
But this is what really tells you everything you need to know about Charlie Munger's approach. In 2011, disaster hits. BYD's earnings just crater. They drop by 90%. Most investors, they would have been running for the exits, hitting that sell button as fast as they could. But not Munger. See, his bet was never on a single quarter's earnings report. It was on the founder. It was on the vision. And because of that deep, unwavering conviction, Berkshire held on. They didn't blink.
Okay, so now let's switch gears and talk about the next generation. In 2011, Berkshire brings on Todd Combs, a guy a lot of people were eyeing as a potential successor to Buffett himself. And right out of the gate, his first major investment showed a way of thinking that, well, it looked pretty darn familiar.
So Combs' first two big moves for Berkshire were MasterCard and Dollar General. And on the surface, right, a global payment network and a discount store, they seem totally different. But when you dig in, when you look under the hood, you see they both have that one classic Buffett trait, what he calls a durable competitive advantage.
So let's get into the numbers that got Combs so fired up about MasterCard. The fundamentals back in 2011 were just beautiful. Almost no long-term debt, which for a financial company is super rare, and earnings were growing at a crazy 21% a year. So Combs does the math, he projects it out, and he sees that a single share could go from $323 to over $1,800 in a decade. That works out to a potential 19% return every single year. In a market where you're happy to get 7 or 8%, that's incredible. This kind of deep, patient numbers-first thinking, it's pure Buffett.
And he brought that same sharp analysis to Dollar General. You might be thinking, how does a little dollar store even compete with giants like Walmart and Costco? Well, the answer is right here on this chart. It's all about profitability. For every single dollar in sales, Dollar General kept 5.3 cents of it as profit. Now compare that to Walmart at 3.5 cents and Costco at just 1.7. It's such a great lesson. Sometimes being smaller, being more focused, actually makes you a leaner, meaner, more efficient machine.
So the takeaway here is pretty clear, right? And it really backs up what the source material says. While Todd Combs is not Warren Buffett, of course not, his first move showed he absolutely gets the playbook. He was proving he was a true protege, a worthy successor in the making.
But Combs wasn't the only new kid on the block. Around the same time, another brilliant investor joined the team, Ted Weschler. And if Combs was the protege, well, Weschler was something else entirely. He was like the mirror image.
To really get a handle on Ted Weschler, you only need to know one number, 26%. That was his average annual return for 11 straight years at his hedge fund. Just let that sink in for a second. He did this straight through the Great Recession. This isn't just good, folks. This is like Cooperstown Hall of Fame stuff.
So how did he pull off a track record like that? Well, he did it with an approach that was just spookily similar to Buffett's. So similar, in fact, that the source material uses this perfect analogy. If Warren looked into a mirror that shaved 30 years off his age, he'd see Ted Weschler staring back at him. That just speaks volumes about how deeply they share the same investing DNA.
And if you look at the Weschler method, it's like you're reading from the Buffett playbook. He's obsessed with reading annual reports. He runs a super concentrated portfolio with just his absolute best ideas. And he holds on to those investments for a long, long time. But, and this is a big but, there's a twist. Look at that last point. Unlike Warren, Weschler wasn't afraid to short stocks, to bet that a company's price would actually go down. It's a riskier play, one Buffett himself actually gave up on early in his career. And that little difference is what makes Weschler's mirror image approach uniquely his own.
So, when you put it all together, what does this mean for Berkshire's next chapter? When you step back and look at the whole picture, what you see isn't just a simple line of succession. It's something much more powerful. It's a combination, a complementary team of different investment philosophies. It's really the perfect mix. You've got Munger, the bold visionary, the one who's always pushing the company into new and exciting places. You've got Combs, the disciplined protege, who's carefully applying those core Buffett principles he learned so well. And then you've got Weschler, the mirror image, who brings that same core philosophy but with his own unique toolkit. This team, this is where Berkshire's real strength for the future lies. It's in the incredible diversity and depth of these minds working together.
And that leaves us with one last really fascinating question. You know, for decades, the story of Berkshire Hathaway has been the story of Warren Buffett. But now, with this incredible team in place, the visionary, the protege, and the mirror image, you have to wonder, is it possible that Berkshire's greatest chapter hasn't even been written yet?